It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
We've got a lot of ground to cover this Wednesday morning. A mixed picture for stock futures as the earnings season ramps up here. Momentum fueling gains after the S&P 500 and tech-heavy Nasdaq notched a two-day winning streak.
And the Nasdaq leading the way higher this morning. This comes after Tesla vowed to speed up its launch of more affordable EVs. Now, the next Mag 7 name on deck is Meta. That company is set to report today after the bell. Let's get right to it. The three things that you need to know, your roadmap for today's trading day. Yahoo Finance's Pras Supermedian, Jared Blickery, and Alexis Keenan have more.
Tesla earnings missed Wall Street estimates, but that didn't stop the stock from surging this morning. Shares rebounding in pre-market trading as much as 16% after CEO Elon Musk says affordable EVs are coming in 2025. Musk declining to say when exactly the cheap vehicles will debut, but did confirm that the EV giant plans to talk more about these EVs on August 8th when its robotaxi will be revealed. Overall, the company had a dismal quarter with profit plunging to its lowest level since 2021, but shares up more than 11% this morning.
And Boeing, they burned $3.9 billion in cash in the first quarter. This was less dramatic than analysts' expectations of as much as $4.5 billion. Facing pressure from airlines and regulators, the company slowed its factories and stopped providing financial targets earlier this year after the door blew out on that Alaska Airlines MAX 9 back in January. Though the aerospace giant is taking accountability by saying it's undertaking comprehensive actions to strengthen its quality and safety concerns. Outgoing CEO Dave Calhoun telling employees the company is in a tough moment, that's a quote, for the near term.
And Congress passes a controversial TikTok divestment bill. The U.S. Senate voted yesterday to approve the bill that could ban TikTok nationwide if the company fails to sell to new owners. The bill is tied to a $95 billion foreign aid package for Ukraine and Israel and Taiwan. It was passed by the House last weekend. Now, TikTok's Chinese parent company ByteDance has roughly 9 months to sell its stake, or the app will be blocked in the U.S. The bill is now making its way over to the White House, where President Biden is expected to sign the bill into law.
All right, let's break down today's market action so far. Right now, we have a move to the upside here, at least for the Nasdaq and the S&P. You're taking a look at the Nasdaq 100 futures moving to the upside, about 0.5% here move, likely to open here in the green. The S&P futures also seeing that slight move here to the upside, just holding on to those gains. A lot of this positive momentum, at least the improvement that we're starting to see in investor sentiment, is driven by the earnings results that we have gotten out over the last 24 hours. Let's take a look at some of those trending tickers here on Yahoo Finance this morning, really painting a better picture of some of that momentum that we are seeing here. Clearly, Tesla, one of the winners here to the upside. We're looking at gains of just about 11% here in extended trading. So huge move to the upside on the heels of its earnings report. Also, Texas Instruments adding to that more positive narrative out there on the street this morning ahead of the bell, also helping the tech sector here when it comes to some of those gains that we're seeing across the chip stocks. You're looking at Texas Instruments up just over 6%. And also taking a look at Visa. We had a new report out from Visa last night. We're seeing that extended move here up just about a 2%. So again, better than expected earnings results once again, really starting to change the narrative on the street. It looks, at least for the S&P and the Nasdaq, on set to open the day in the green. And again, this bounce back continuing following last week's very challenging week here for the market when you had the Nasdaq closing off more than 5%, Brad.
Is the theme for today's show, big earnings energy. Let's get to today's top story. Boeing burned $3.9 billion in cash in the first quarter. This was less dramatic than analysts' expectations, up as much as $4.5 billion roughly there, facing pressure from airlines and regulators. And the company slowed its factories and stopped providing financial targets earlier this year after the door blew out on the Alaska Airlines MAX 9 flight back in January. Outgoing CEO Dave Calhoun telling employees the company is in a tough moment for the near term. Joining us now with more on this is our very own Pras Supermedian. Yeah, I mean, obviously, yes, a tough moment, a larger question of what the board, what executives will do to navigate this tough moment right now, too.
Yeah, I mean, a lot of unknowns here. I mean, you kind of said it all just now. The whole story's right there. I mean, look, they beat. They had a narrower loss than expected. Revenues higher than expected. But like you said, negative operating cash flow, $3.4 billion. free cash flow of negative $3.9 billion. I mean, these are just astounding numbers that seem unsustainable. Calhoun saying that lower volumes and deliveries reflecting their actions to drive improvements in quality for that 737. After that door plug blowout, everything sort of changed for them yet again. What's missing, of course, we don't have that production plan of what is their plan for planes per month, right? We don't have that yet. It's still kind of in the early stages here. We have no guidance on what they expect for their profitability and revenue because, of course, we're looking at a company that can't tell when it's going to be able to be back to normal. Investors sort of flying blind here in Boeing, but if you're Boeing, there's only you and Airbus are only two games in town, right? They still have a $44 billion backlog. You still got to go to one of these two players.
Right.
And for Boeing, they think they can weather this. It's not like it's existential yet, right?
Yeah, and perhaps, to that point there, what has been the feeling amongst the street? Because when I was taking a look at the analyst ratings right now, a number of the analysts, we're going to be talking to one later on in the hour, still have a buy rating on this stock, despite the fact that it's one of the worst performers in the S&P so far this year.
Yeah, I mean, I think if you buy the turnaround plan of, Calhoun is going to go away at the end of the year, who's going to come in? That's a big part of this story. Steve Mollenkopf taking over the board now. So I think that's the bet there is that, like I said, there's no other games in town, right? So they have to either ride the ship or something's going to change. And look at that backlog is huge. I mean, the stock's down, $169 now. This used to be a $354 stock. I mean, so there's a lot of upside there potentially if they can get everything going. The 737 MAX is still a widely needed airplane amongst a number of hundreds of airlines. So that's the kind of the bet, I think.
All right, Pras, while we have you on set, let's talk about another stock that you're following extremely closely here, and that is Tesla's shares are surging this morning. Now look at that move, up nearly 12%. Now this comes despite reporting a 55% decline in profit from a year ago. Now the company is facing setbacks from ongoing price cuts. Well, CEO Elon Musk, though, comforting investors just a bit on the earnings call, touting production of a new affordable EVs and the fact that we actually might see them sooner than initially anticipated.
For vehicle lineup to accelerate the launch of new models ahead of previously mentioned start of production in the second half of 2025. So we expect it to be more like the early 2025, if not late this year. These new vehicles, including more affordable models, will use aspects of the next generation platform, as well as aspects of our current platforms, and will be able to be produced on the same manufacturing lines as our current vehicle lineup.
So Pras, he was very positive just on, I guess, when exactly we could see these cheaper EVs. But I'm curious to get your reaction because when you take a look at this earnings report overall, there was a lot to not like within this report. Yet the street seems to be focusing on that one thing that came in a little better than expected, or at least sounds like it's going to be better than what we initially anticipated.
I mean, yeah, this is a big deal in terms of them. The headlines crossed. It was Tesla accelerating plans to launch a cheaper vehicle. That was a huge thing that everyone wanted to see. No one thought that they'd actually get that. Knowing Musk, the mercurial nature of him, he'd be like, no, you know what, this is what you're going to get, the same old story, that's it. But I think he recognized that there was a lot of lost confidence in the stock amongst his biggest fans on the street, and they had to actually do something. So they announced that we're going to accelerate the cheaper vehicles, new vehicles coming 2025, even as early as late 2024. The robotaxi, of course, is going to be revealed on August 8th. So I think the street wanted to hear these things. And never mind the fact that we had a horrible quarter in terms of like profitability, gross margin, et cetera, et cetera. So, and also we don't have clear guidance on their vehicle delivery sort of forecast for the year.
Yeah, look, I'll be frank, I have more questions on this process, and it's great that I do because we've got a guest coming up that's going to speak a little bit more about this as well. Pras, thanks so much for taking the time. You can stick around if you want. The seat is there. Tesla shares, they're up over 11% in pre-market trading. The move higher in shares offering investors some relief. The stocks had a rough start to the year, down over 41% year to date, heading into the release here, but moving higher, as we were mentioning, off of this report. To break down the street's reaction, Colin Rush, who is the Oppenheimer managing director here. And Colin, I'm so glad we have you because for the street hearing now that you have a new affordable vehicle that's going to be fast-tracked or moved up in the roadmap here, is that what the street wants to hear at a time where you've already seen price cuts be initiated or some of the different pricing strategy play out that has a larger impact on the margins that we also have to consider for Tesla?
I mean, this has been a growth stock that's stopped growing. And so what the company really needs is an incremental growth driver. The Cybertruck has been incredibly disappointing as an incremental vehicle. And so they're trying to refresh the product suite. And part of the issue here is that they've saturated demand on the Model 3 and the Model Y. they've been huge successes, but the next leg of the story has to be this lower cost vehicle. Now, we have a lot of questions around the specifics here. I mean, they gave us a rough time frame on when they would start production, but the actual integration of a new platform with the existing platform is a relatively complicated challenge. And we'll see how the actual cost structure plays out as we begin to see some of the production. And I think it'll probably be early next year rather than later this year.
Yeah, Colin, talk to us just about that realistic timeline. And if we don't see a cheaper vehicle by the end of the year, is that something that you think is going to hit the stock here in later quarters?
Well, this is something we're talking about with investors. This has gone from a stock that had, real numbers, and we went from being a story stock for a lot of years to having real results that were driving the stock higher. And we saw that move a number of years ago to returning back to the story stock, element of the stock. And it's interesting to have the story be one, a low cost vehicle that's pretty nebulous at this point, as well as the robotaxi. Obviously the promise of, Tesla being the leader in AI for the physical world is, I think, very compelling, and one that we think is real over time. How that translates into financials is really a big question mark right now. And with the Model 2 or this low cost vehicle, we don't know where the price point is going to be, what the cost structure is going to be. And so we think there's maybe another one or two numbers cuts before we start to see things inflect higher.
So, Colin, then it sounds like the worst for Tesla isn't behind it yet. Is that right?
From an execution perspective, I think they're going into a very challenging period. They've made a bet that the learning cycles on their neural net will accelerate here between now and August, and that they'll continue to improve the functionality on the FSD. And we think that's not a certainty. There's a lot of debugging that has to happen and a lot of work to get that moving in the right direction at the pace that they're talking about. We think they're on the right path, but there's a lot of hard work. And at the same time, merging two vehicle platforms is not a trivial endeavor, and something that we think probably has been put on the drawing board for them and on the plans just here in the last 4 to 6 weeks.
Colin, the company talking about and the chief financial officer talking about on the call the ability to reduce costs without sacrificing on quality due to the amazing efforts of the team, yada, yada, yada. But sacrificing on quality, that's continued to come up in conversation either via recalls or even via some of the initial reviews of the Cybertruck when people were talking about the paint on the side or the rusting that was taking place. So are consumers getting the bang for the buck that they've come to expect or anticipate when they're getting into a Tesla? And how does that, in one way or the other, impact their decision to purchase with Tesla as a repeat customer in the future versus going to some of the other automobile manufacturers who are themselves eyeing some EV ambitions?
I think it's a good question. So there's a couple of things that I'd say about that. First, we've gone past the point of early adopters who are going to be pretty forgiving around some of the finish and fit issues that Tesla's run into. At the same time, the company's done an incredible job on cost reduction. They continue to walk those costs lower by designing out, elements at the system level. They're enjoying some tailwinds on the battery side right now. And so the balance of quality and cost reduction, I think they're doing a reasonable job on that. That said, as you get into a broader pool of consumers, the tolerance for some of the difficulties that folks have around, delays on repairs, some of the cost of those repairs, some of the details on the car, I think diminishes. And so the company has to do both here. They have to improve quality and they have to continue to walk costs lower. And it's a pretty high bar, especially if you're going to start looking at a new platform on a very accelerated time frame.
Even as we're watching shares move higher today, for some investors that are still a bit perplexed after this earnings report and trying to figure out what's the clear buy signal, what is that clear buy signal that they could potentially be looking for if they're looking to add Tesla to the portfolio, even if they're going into what you mentioned as a period of operational challenges?
For us, we're still on the sidelines here. We think this rally this morning is largely a cover rally and some short positions. We think that's going to start to fade as we get through the balance of the trading, today and over the next couple of weeks. And I don't think if you've got a short thesis on Tesla and margin and price erosion, you walked away from last night's quarter with a whole lot of concern, other than the margins were just a bit better than you expected. And so there's still intense price competition. There's still an awful lot of work for these guys to do to bring this new model forward and continue to drive cost out. And at the same time, the company's taking on some incremental technology risk in the commercialization front. And I think they're pioneering this AI in the physical world market, starting with FSD, but it's a lot of work and it's a lot of management focus to get that together. And so I think what you want to look for if you're going to buy the stock is a point when numbers aren't going lower. We lowered numbers this morning. We think there's another 1 or 2 cuts left to go. And the point that you start seeing numbers begin to go higher on both the revenue and the margin perspective, then I think you can start buying the stock. But I don't think we're there yet.
Yeah, margins better than feared, as you mentioned, but the margins on the auto side still declined from 18.9% to 18.5%, excluding the Cybertruck impact as well. Colin, thanks so much for taking the time here today, breaking down all things TSLA with us. Colin Rush, who is the Oppenheimer Managing Director. Appreciate it. President Biden is expected to sign a potential TikTok divest or ban bill today. The bill is a part of a larger foreign aid package for Ukraine and Israel that effectively gives ByteDance until 2025 to find a new American owner or have its app banned from the country. To break down what legal challenges the bill might face, Yahoo Finance reporter Alexis Keenan is here all over this one. Hey, Alexis.
Hi, guys. Yeah, good morning. So a big move by the Senate yesterday. It was expected. And President Biden has said he will sign this bill into law as soon as today. So what that would do is it would start the clock running on this divest or be banned nationwide in the U.S. bill. It would be 270 days the clock would run. And then there's some leeway for an extension for TikTok that would bring it to that 9 months that it could take advantage of if the U.S. government found that it was making some progress in this divestiture. So what TikTok is going to need here is going to be a fight, and it's going to need a constitutional fight, right? Because once a law is passed by Congress only answers to the U.S. Constitution. There's nowhere else to go. So what will those claims look like? Some of these arguments might include a First Amendment speech claim. That's like what we saw in the case where Montana had passed a law that was banning the app from U.S. users, from Montana citizens' phones, and from app stores being able to allow it to be available. Now, those First Amendment claims, legal experts say, are not probably going to win the day here. And that's because users, right, that are putting their speech out on this platform, they have other platforms on which they can publish their content. They have Facebook, arguably, they have Instagram, they have Twitter, and the myriad of social medias that are out there for them to do that. Now, some other arguments could be one that's been raised by these legal experts, bill of attainder. That's when government passes a law and makes something illegal that wasn't illegal before, and now says, we're going to go back and punish you, TikTok, ByteDance, for those actions. U.S. often wins those cases. The government usually is the victor there. Also, equal protection, that's one that could be raised by TikTok. Also, not great. We often disadvantage foreign companies in the U.S. on national security and other grounds, privacy grounds. And these are the types of things that the U.S. says it's trying to protect. So the courts are going to zero in on the intent of the U.S. in passing this law. That is going to weigh heavily as the courts consider these constitutional arguments. But what we can expect, and TikTok has promised it, ByteDance has promised it, we can expect an injunction, we can expect a dogfight in court over the app being able to remain available in the U.S. Guys?
All right. And something we're going to continue to follow here very closely at Yahoo Finance. Alexis, thanks so much. Well, we are just getting started here on the Morning Brief. Coming up, stakes are high for Meta. Zuckerberg's turnaround will be put to the test this afternoon when the company reports first quarter results. We will break down what to expect. And later, it certainly has been a rotten year for Apple, from slumping iPhone sales to a potential antitrust suit. The tech giant has been making headlines left and right. What does Apple need to do to deliver for investors next week? We are going to discuss. And Boeing's troubles continue to mean more expensive summer trips for consumers potentially. Join us in Wealth. We will discuss what the Playmakers issues could mean for your wallet. We've got all that for you coming up. We'll be right back. Durable goods orders rising 2.6% on a monthly basis in the month of March. It was slightly higher than what the street had been expecting. Another sign that the economy remains resilient even with stubbornly high inflation. Recent data is causing economists to reconsider their forecast for the Fed. Our next guest recently pushing his rate cut outlook, now expecting the first cut not to come until December. We've got Matthew Lazzetti, Deutsche Bank's chief U.S. economist, here on set with us. Matt, it's great to see you.
Great to be here.
So talk to us just about the recalibration and why you don't see the Fed cutting now until December.
Yeah, so our reassessment came after the latest CPI report, but it was not just about that single report. What we've seen is 3 straight stronger than expected inflation prints. Most important for the Fed is what happens with inflation and whether or not they have confidence on disinflation. But it's coupled with very resilient labor market data, very resilient GDP data, as you kind of mentioned. You know, the labor market reports have been producing more than 200,000 jobs per month on average. Equity markets are buoyant. Financial conditions have been quite easy. So all these things together, I think, has caused us to reassess when the Fed is likely to cut rates, and I think we're hearing more hawkish signals from the Fed as a result of that as well.
If we get too close to the election, and your first cut that you're pricing in as well, December, so after the election here, which would satisfy the Fed's desire to look apolitical, excuse me. But at the end of the day, there was a lot of conversation coming into whether or not they should or could cut if things got dire enough going into an election. What do you think the calculus would be there?
Yeah, I think first and foremost, if the data are making a clear case for cutting rates or raising rates, for example, the Fed would do so.
A raise? You think they could still raise?
I don't think that they would, but I think if you were to see this big acceleration in the inflation data, more likely would be that they cut rates. But if it's a clear case, probably driven by a weakening labor market and growth data, they could cut rates around the election. I think it's more complicated if it's just about inflation. The Fed is thinking about cutting rates because of disinflation, but inflation is still well above the Fed's target. And so cutting rates for the first time just based on inflation right around the election, I think is more complicated.
What do you think the path looks like ahead for inflation? Could we trend higher? Is it more likely we're going to trend sideways? What do you think that movement's going to look like over the next couple of months?
Yeah, so our forecast for core PCE at the end of this year is 2.7%. We think on Friday it's going to show 2.8%. So mostly sideways from here. I think you're going to have certainly gyrations within that. We have a lot of base effects that'll influence things. In the near term, over the next several months, I would expect that you see inflation decelerating a little bit, but actually then reaccelerating over the back half of the year.
What is the wage kind of input of data that we're going to be receiving next week? What does that signal for the inflationary picture that the Fed's going to be kind of jousting?
We'll get the employment cost index, which is really important. If you look back at the Fed and when Janet Yellen was the chair, she would often reference the employment cost index as the best indicator for wage growth. I think what you see from broad-based measures of wage growth is continued deceleration. I think what you see from leading indicators, the best one is the quits rate. The quits rate is at the lowest level since 2018, essentially. It's showing that wage growth should continue to decelerate. From my perspective, the labor market at the moment and wage growth at the moment is not an additional reason for the Fed to be hawkish, but the inflation data certainly is.
Matt, I'm curious, when you take a look at some of the data that we've gotten out most recently, and going back to yesterday's print on PMI, it did show some weakening when it comes to labor. It did show a decline here in manufacturing. It is just one print, but is that a signal that maybe the economy isn't as strong as some of these other data points have pointed to in recent weeks?
Yeah, you've gotten, over the past year, some head fakes, I would say, from these survey-based indicators, especially the ISM Services Employment Index actually collapsed last year and then completely reversed in a given month. And really, drove a short-term move in markets. I think really until you begin to see that soft data, the survey data, filter through into weaker hard data, it's really hard for the Fed or anybody to respond to that. Yes, it was a weaker employment component, but we've been seeing over 200,000 jobs per month on average. The unemployment rate is near historically low levels. There's no really other indicators that are telling us that the labor market is falling apart at the moment.
The Fed stuck on transitory for too long previously. Is there a risk that they could stick on higher for longer for too long?
Certainly it's a risk. I think that they've been talking about risks coming into better balanced, but they were talking about that at a time where they thought disinflation was very clear. I think when we hear from Chair Powell next week, he will continue some of the recent language that we've heard from Fed officials, which is, if you look at the economy, there's just no urgency to cut rates. Growth looks fine. The labor market looks very resilient. Inflation has some upside risks. But they are kind of cautious about the idea that, yes, if you hold for too long, what looks like a soft landing today could be jeopardized. So that risk is no doubt out there. The task for them is trying to balance those risks as we look ahead.
Do you think it's most likely we will see that soft landing scenario, it sounds like?
We do. I mean, we do think that you get a soft landing. I would say though that the higher inflation is, the longer that it's higher, the more that pushes the Fed to maintain a restrictive stance, and the greater the risks are. Right. So those risks have risen over the past several months.
Matthew Luzetti, who is the Deutsche Bank U.S. Chief Economist. Thanks so much for joining us here today. Appreciate it.
Thanks, Ryan.
Great to see you. Let's turn now to some trending tickers that we're watching on the Yahoo Finance platform. AT&T shares climbing higher after reporting postpaid phone connections growing by 349,000, during the first quarter. That's well above the nearly 304,000 that analysts were expecting. This comes after its competitor Verizon reported a loss of 68,000 postpaid phone subscribers for the same period here. A few things to really break down, and I think you're going to hear a lot of executives continue to talk about this going forward, especially as they think about the guidance and the near-term future. Normalization could be one of the elements you start to hear about a little bit more as it pertains to the guide here, with the revenue growth, the services revenue growth that they're talking about, 3%, broadband growth of 7% here. And so all of that considered, what does normalization also look like for where customers are having the propensity to continue to spend into their plans? It's really tracking delinquencies, and that's where it's going to be interesting to see or hear a little bit more about the payment quickness. As of right now, what we've heard from many of the telecom companies is that the consumer is resilient, the consumer is still healthy, but at the same time, you have to wonder what's going to be that next big product that gets them into a new device. And that's where it actually hit on the equipment revenue side of the business here.
Yeah, and I think that's smart to point out here. And also when you take a look underneath the surface, yes, subscriber numbers did beat expectations, and that seems to be overshadowing some slight weakness in this report, at least when you take a look at the average revenue per user in both wireless and broadband services division. That slightly missed what the street was looking for there, and that was likely a result of some of that increased competition when you're seeing some of the other names be able to grab more market share. That, of course, could put some pressure here on a name like AT&T. But again, it was better than expected. They had free cash flow of $3.1 billion. That topped the street's expectations of just around $2.5 billion. Lighter capex spending there on that front. So at least how the street is looking at this print, it was on the surface, or at least the headline numbers here, better than expected. And that was enough to see this lift of just around 2%.
Do you think generative AI is enough to get people into a new phone? I mean, I'm still holding on to my phone from 2021 right now.
I hope so. Yeah, I mean, I think so. I think as people start to see those day-to-day applications and what exactly it could do for your life on a daily basis, I think it's going to be enough to maybe say that, hey, now is the time to upgrade a phone. And we know that Apple, it seems to be at least hoping that that certainly is the case, because if it's not, then they have a bigger issue.
Maybe it'll edit scripts for me as well. All right, everyone, we're counting down to the opening bell on Wall Street. Of course, we've been seeing some mixed activity, but mostly positive, at least for 2 out of the 3 of the major averages here in the U.S., with the S&P 500 and the Nasdaq in positive territory in the futures, and then the Dow futures pointing lower. We've got the opening. Is that UConn? Do they have the Husky up there?
They've
got
there.
the Husky. My goodness. All right, some national championships being celebrated at the NYSE over these past 2 weeks there. All right, the men's basketball team representing. And then you've got Copart at Nasdaq. That's the opening bell. Let's do a quick check of the markets, sponsored by Tasty Trade. Taking a look at the U.S. major averages, the Dow right now, the lone laggard, flat just barely to the downside by about 0.1%. We'll round that off to. And the S&P 500, that's in the green. It's up by about 0.3%. Nasdaq Composite up about 0.6% right now.
It's also important to keep your eye on the tech sector here today. You can see the outperformance, at least here at the open of the Nasdaq. That's up 0.6%. Tesla really driving that improved sentiment on the street here this morning. We are going to be getting Meta after the bell here today, but I think a lot of investors are going to be focusing on the performance of Mag 7 and exactly what that tells us maybe about the pace of earnings season here over the coming weeks.
I'm interested in this Meta call. I'm waiting to see what they say about some of the new functionality on the AI front that they've actually put into Instagram recently in that search panel as well. So changing up some of the UX, the user experience for all the folks out there. I know some tech terms.
Okay, right here on Yahoo Finance, we've got more tech terms maybe coming up here in the next hour, but also another Mag 7 stock that we're watching is Meta, the tech giant, reporting Q1 earnings after the bell. We will tell you what investors need to watch out of its quarterly results next. Focus is going to shift to another Mag 7 member after the bell today, and that is Meta. Shares are up over 40% so far this year. Investors are going to be closely watching its first quarter report for any insight into progression surrounding AI. Yahoo Finance's Madison Mills joins us now from the newsroom with more. Maddie.
Well, Shauna, just to mention the record-breaking report from last quarter that Meta has to beat this time. It's a really high bar to clear, right? They announced a $50 billion buyback program that led to record-breaking salary for their very own CEO, Mark Zuckerberg. And they also announced that as part of that news, they saw a $200 billion bump in their market cap in just one day, adding the entirety of a McDonald's to Meta's market cap in a 24-hour period. So a really banner print for Meta. That's part of what led to this huge tear on the stock, up over 43% year to date, far outpacing, by the way, the Nasdaq, which we've been talking about the Nasdaq rally year to date, obviously seeing a little bit of a decline in that over the past week. But Meta clearly one of the top two picks when it comes to the Mag 7 trade if you're looking at Meta and Nvidia compared with the other seven. Now, here's what investors need to be looking at as we head into the earnings print later today. As you mentioned, Shauna, Gen AI and advertising revenue. We saw that 97% of Meta's revenue last quarter was specifically due to advertising. The street is looking for a beat to 97%. Not much growth you can get from there, but they're hoping for 98% this time around. And they're hoping for their generative AI advertising revenue to be a significant contributing factor to that. So that is going to be a key thing to watch coming up here. Also, another key question when we look at Meta is that they've been on this cost-cutting expedition here, right? That was the theme for them through all of 2023. It might be time for Meta to say, actually, we're going to use that cash that we have on hand. We're going to either give it back to investors or invest in our own R&D through either continued purchases of chips or other R&D efforts. So that is going to be the key question. If Meta does have that strong capital on its balance sheet that we anticipate, what are they going to do with that capital?
What are they going to do? My gosh, Madison, I can't wait to see how they answer that question later on today. Appreciate it. Tracking all things Meta here. Let's shift some focus to the chip space. Texas Instruments, their shares are climbing higher after saying revenue for the current quarter will be well above what the street was expecting, giving investors hope that the company's demand struggles could be shifting. Shares for the ticker symbol pronounced Texan, TXN. You're seeing it moving higher by about 7% as of right now. They talked a lot about the areas that they're going to stay focused in areas that add value in the long term, investing in some of the competitive advantages, manufacturing and technology, and then additionally here, looking at disciplined capital allocation. So you got to wonder exactly where those kind of portfolio plays that they have of their own in terms of the segments that this company operates. Everything from semiconductors to that TI-84 Plus calculator that a lot of us had back in high school and we're really just playing block dude on. At the end of the day, this is that company, and we'll see where they decide to place some of that capital. You're smiling. I know you were.
I remember that.
I know that you had that calculator.
I haven't thought about a TI-83
We had to get
calculator
it
in quite some time. But you're exactly right. I mean, at least for this company, at least why we're seeing shares move to the upside here, a lot of that is based on guidance. Because when you take a look at these numbers, at least revenue still declining 16% during the quarter. It was the lowest level that we have seen since 2020. But the commentary that we're getting within this earnings release pointed to the fact that sentiment is starting to improve, and maybe that slump in demand that the company has suffered over the last several quarters, it is starting to ease just a bit. And they suffered more than a year here of falling sales. So investors have been waiting for this turnaround story to really start taking place. And remember why this is so important, right? It's a bellwether for the broader chip sector. It's the biggest maker of analog semis, also embedded processors here, used in a lot of those household electronics, used in cars as well. So clearly it is a bellwether for the industry, and that's a big reason why we're seeing many of these chip names trade to the upside today. Again, Texas Instruments, the outperformer of the group that we have up on your screen there, with shares up just about 6%.
Yeah, and they mentioned the money that they got from the CHIPS Act on the call. They were asked about that from one of the analysts, saying you still have like $9 billion outstanding for mature nodes. So talk about that for us. And essentially all they said was, to date, they've accrued about $1.5 billion on the credit, and then they are also going to be receiving more of the cash benefit throughout the year in 2024 beyond, and then they're also going to be receiving about $300 million, total of $1 billion for all of 2024 as well here from that.
All right, well, let's talk a little bit more about earnings season. 180 of the S&P 500 companies are reporting results this week. So far this earnings season, about 74% of companies have beat on earnings. Nearly 60% have top sales estimates. That's according to the latest numbers out from FactSet. Here with more on what exactly this means for the market's momentum going forward, we want to bring in Drew Pettit, joining us here on set, Citi's U.S. strategist. Drew, it's great to see you finally in person. Thanks so much for coming in.
Well, happy to be down here. Thanks.
So it's a huge week here for the markets, like we were just laying out, at least when it comes to earnings. We've seen some of that momentum shift here this week. We're seeing a bit of that momentum to the upside. Is that going to continue, do you think, as we get more of these results coming in?
So I don't want to be the bearer of bad news necessarily. I don't want to be viewed as a bear, maybe a little bit of a teddy bear at this point. But we just had a pullback. We reset some expectations. So a little bit of a cleaner setup, but I don't think we've fully reset risk reward from here. We're still preaching patience. Our full year target's still 5,100. And to be honest with you, I know you gave some great stats on how many companies have beat. That should be expected this quarter.
Mm-hmm.
So what is the ultimate theme that you expect to prevail, even as we're looking at, who's beating, who's missing, and where some of the forecast is really being looked at to signify where demand is remaining strong for the companies?
Okay, the overall theme we expect for this quarter is beat and hold.
Okay.
So that's not really exciting at this point. I think a lot of companies are basically going to use the run we've had year to date, especially in a lot of the growth names that have outperformed, to maybe temper some expectations, because we think the back half, it's going to get a little bit harder to beat, especially when we get to Q4. I know you just had an economist from one of our competitors in talking before. If you look at a lot of the projections, yes, revisions have moved higher for GDP across the board for a lot of the big macro trends. But consumption, real GDP, that demand, those growth rates are expected to slow because inflation's been a little bit stickier. So that's a bit of a headwind. But on the flip side, again, not trying to talk out of both sides of my mouth, but there's puts and takes here. We're starting to see the manufacturing economy come out of its recession. We're starting to see cyclicals improve. So while the growth names in the index might have a tougher time growing off of tougher compares from last year, the cyclicals in that part of the market needs to contribute to the earnings growth story for the index.
So it sounds like you're expecting a lot of those, Mike, 7 names that we've been talking about here today and really over the last several weeks. We're going to see some pressure, maybe potentially in those names following their earnings results, given the tough comps later this year?
It's not even just the tough comps later this year. Honestly, it's kind of law of large numbers. They're growing at a high rate. It's hard to continue that forever. But where some of these stocks are priced, like you guys were talking about semiconductors, I think that's a great example. They're not just pricing in a good quarter, a raise for next quarter, a raise for this year. They're kind of pricing in like compound annual growth for the next 5 years at 25 to 30%. That's how we do this reverse DCF work to kind of figure out what's priced in, not what do analysts expect, but what is the market pricing in. And that level of compounding growth does not leave much room for error. So I think it's the long-term expectations that set a high bar for those companies. So you don't just need a beat and hold to help move the stock higher or sustain the levels. You need a beat and raise and confidence in the very long-term trajectory of these companies.
And so if we don't see that from companies, then how does that kind of position the broader market rally, especially given that we had seen some slippage last week, we saw some volatility, and then additionally coming into the start of this week, we're thinking about whether or not those 5 names could really put the rest of the team on their back, as Marshawn Lynch would say back in the day, and continue to power a rally further from here.
Love a reference to a Bills player. But I think we'll keep getting a little bit of chop in markets. I honestly, nothing works in a straight line. I think this market is going to be an example of it. Honestly, it's when it comes to these growth stocks, I think a little bit of a pullback and a reset is healthy. We like the fundamental story. I think that'll put a higher floor under markets. It'll put a higher floor under the growth names from here. We're not calling for a big, massive correction, but I think around 4,800 mid-year, you can probably be a little bit more aggressive.
Drew Pettit, Citi U.S. strategist. Thanks so much for taking the time. Great to see you in person.
Yeah, thanks for having me in. Really appreciate it.
Absolutely. Well, coming up, everyone, Boeing shares climbing higher after reporting a better first quarter than expected here. Relief, given its recent safety concerns. We'll dive into those results next. A brutal start to the year for Boeing, all lead to its first quarter results, which were not as dramatically bad as the street expected. The plane maker beat estimates on its top and bottom line, even as it faced pressures from consumers and regulators after the door blew out on the Alaska Airlines MAX 9 flight back in January. But let's dive a bit deeper into three key figures from these results, starting with that adjusted free cash flow number here. Now, ultimately, Boeing saw negative $3.9 billion in its first quarter. That's lower than the negative $4.5 billion that analysts were expecting. That's your first point of relief. And then commercial airplanes revenue, a big miss there. Boeing saw $4.65 billion. The estimate was looking for, north of $5 billion, actually closer to $5.5 billion to come in there. And of course, it's important to remember that there's really only two big players in that space. It's Boeing and it's Airbus for the large plane orders on the commercial side here. And then finally, we've got to talk about that backlog growing once again to $529 billion or 5,600 commercial airplanes. And here's why that matters. Now you've got airline operators who are expected to take delivery and ultimately be able to infuse that into their own route schedules. They're not able to do that, at least in this interim or near-term period of time, at the cadence that they were expecting. So now for you, the customer, and perhaps the investor, that means rejiggering some of your calculations on how much the customer is willing to pay, how much routes and how many routes that these airlines are still going to be able to fly, and when Boeing is actually going to be able to deliver them, and at what cost. It's probably going to mean that they might have to acquire a little bit more here. And Spirit AeroSystems, one of the major companies that Boeing may need to go after, especially coming off of a major quality assurance day that they shut down operations for in order to make sure that they could get a better handle on where some of the gaps in their overall operation and system were and remove even more of that pattern of negligence that became apparent in the 2018 and 2019 crashes, which also involved the MAX. Well, so far, the street has mostly brushed off the aerospace giant's struggles, with over 60% of analysts covering the company holding a buy rating on the stock. Our next guest is one of those analysts. We've got Bert Subin, who is the Stifel Senior Research Analyst. Bert, great to see you here with us this morning. First, foremost, let's just get broad stroke, your takeaway from this Boeing report.
Yeah, well, thanks for having me back, and I think you gave a pretty good synopsis there. The first quarter earnings, I think, were always going to be relatively unimportant. There was so much disruption in the first quarter. You had the cash compensation that's going to United, Alaska, and others. You're producing aircraft at a very, very low rate, and making a lot of changes to ultimately get your arms around quality. And so there were a lot of costs absorbed in the first quarter. Like you noted, free cash was a little better, so that was encouraging. I think that was probably the highlight. And I think part of that was BDS driven, so the defense business was better than expected. And BGS, which is the services and aftermarket business, was also quite a bit better than expected. And so that combo helped. The commercial airplane business, continues to struggle. But I think we heard some encouraging remarks from Dave Calhoun this morning. The company's still looking to draw down its inventory this year, which is good. They're still planning to acquire Spirit potentially this quarter, which is, I think a positive. And they're sticking by their $10 billion free cash target in 26, which is surprising. But I think it, speaks to their confidence in the ability to right the ship. So certainly some investor skepticism there, but I think they're saying, a lot of the right things this morning.
Bert, you mentioned that the acquisition of Spirit AeroSystems you view as a positive. Why? What is it going to do to the business in the long term?
Yeah, I think people maybe think of it differently. If you're looking at this as a typical deal, where is this going to be accretive, or how much is this going to reduce capital intensity or things like that, you wouldn't like this deal. But the reality is, Boeing's number one issue has been sort of getting its arms around, quality and its supply chain, and Spirit is a huge part of that. And there have been quality lapses in recent years. And so by acquiring Spirit, you can better integrate, and to a degree, vertically integrate their supply chain and give the customers and the regulators greater confidence that you're going to produce the highest quality product every time. And so from that perspective, I think it's really important for reputation and for sort of showing, an actionable step toward improving the business. And so Spirit is not a small company, but relative to Boeing, it is pretty small, right? The enterprise value is somewhere circa 5-ish% of the total Boeing value. And so it's not something they couldn't digest. And I think, down the road, there could be positives for margin accretion, but that's certainly not the focus near term.
Bert, at what price is Boeing paying too much for Spirit AeroSystems? I mean, the stock rose for Spirit AeroSystems by about, 15% after the kind of rumor mill was running and the talks of the deal started to emerge there. But at what price are they paying too much?
It's a great question. I think there's a wide dispersion of people's expectations here. We've said $34. The stock was trading around 28 and change before the announcement. That would represent sort of north of 20% upside, which would seem like a reasonable premium considering a lot of the cash headwinds that Spirit has and a lot of the advances that's taken on from Boeing and Airbus. I think the reality is it's probably not going to be that simple because this would assume that Boeing just goes out and buys Spirit. And what it seems to be the case is that they're probably going to divest Airbus assets and perhaps some defense programs and then buy sort of the remaining piece. And so that creates a lot of complexity for assessing that. But if you're just looking at it on a total basis, we've sort of viewed 34 as reasonable, which, slightly ahead of where it is today.
Yeah, certainly. Trading right now at about $32.50 here per share. Just lastly, let's go to Paris, if you will, the Paris Air Show. If Boeing does not have a standout performance at this Paris Air Show, which is coming at about the end of the quarter in June, then what for the rest of the year? What does that signal for the outlook from your perspective?
So orders have been pretty good to start the year, right? I mean, the backlog is at record levels. They were able to book a big American order, the 787, I think is gaining a little bit of traction as well. So this summer we'll have Farnborough. Paris is every 2 years. So we'll have Farnborough in July. And I think that'll be an opportunity for Boeing to get out there, particularly if they're starting to improve or sort of communicate that improvement to customers, could be an opportunity for them to start selling more Maxes again, which has, been something that, we've seen little fits and starts, but, that would be an opportunity if they can show customers that, they're getting back on track, could be an opportunity to pull in some more orders, which would be important because you get the advances, the free cash, and then, you could sort of see the reputational concerns starting to ease.
Bert, you are right. It is in 2025. And guess what? I'm going to be updating my calendar after we hop off. Bert Subin, who's the Stifel Senior Research Analyst. Bert, thanks so much for taking the time.
Thank you.
Appreciate it. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Let's get to some earnings in the healthcare sector here. Drug maker Biogen reporting earnings today, beating street expectations, boosted by the company's cost-cutting efforts, plus sales of its closely watched Alzheimer's drug. For more on this, we've got Yahoo Finance reporter Anjali Kamlani here with us to break it down. Hey, Anj.
That's right, guys. And Brett, we're talking about this Alzheimer's drug. That is really the focus for Biogen, along with its partner Eisai, finally getting out of the gate with Leqembi after the phenomenal saga that we saw with Aduhelm. And so they're getting over that hump right now. Saw sales reaching 19 million, which is less than what the street estimated, which is about 30. So they were more optimistic. So they missed on that front. They've also missed on the number of patients they've been able to on-ramp, with a slight jump in March. So they're hoping to really get that flow going through the rest of the year. And that's what analysts like those at Wedbush are looking at in particular, with waiting for that enthusiasm to take hold and waiting to see if the company can in fact get past the saga from the past, as well as get more patients on this drug. That's where the focus has been for investors. We also know that there are other benefits that Biogen saw this quarter, including from its tie-up with Reata. Those drugs also helping to boost the stock, as you see on your screen, up. So giving investors some hope when they had kind of started to give up a little bit, as you can see from the stock action. So looks like they got a little bit of some love today.
All right, Anj, thanks so much for breaking that down for us. Keep right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. Welcome back to Yahoo Finance. I'm Shauna Smith alongside Madison Mills. We're 30 minutes into the trading day, and it's certainly all about earnings. We've got a jam-packed hour for you coming up. But first, we got to start with the movement that we're seeing in Boeing and Tesla. Those are two names that are really dominating the market conversation. So let's get right to it. The biggest stories that are moving markets this morning. First up, Boeing shares climbing higher after the company burned less cash than initially feared in its first quarter. The move higher this morning is stemming some of the stock's losses from the start of the year. Now, Boeing is still grappling with the fallout after a door plug blew off an Alaskan Airlines flight back in January. You're seeing some relief for this stock here off the highs of the morning, but still up about 0.8%.
And a similar story with Tesla in terms of less bad news being great news. Tesla shares surging this morning, up nearly 14%. That's also driving the Nasdaq higher. Investors optimistic about the EV maker's recommitment to a lower cost vehicle that's quelling concerns about the company's growth potential moving forward amid that broader slowdown in EV demand.
And Meta is the next Mag 7 member to report quarterly results, and it's all about AI. Investors will be watching to see if the social media giant can keep that momentum going. We're looking at some gains ahead of those results, up just about 0.7%, but clearly a massive outperformer since the start of the year. And Yahoo Finance will have those quarterly results for you after the bell today. But let's start with what's moving the markets this morning, and that's two of the S&P 500's worst performing stocks of the year, Boeing and Tesla, are actually moving to the upside. So let's start with Boeing. For me, Maddie, this is all about the cash burn and the update that we got there. So we're seeing some relief in shares today with a move higher of just about 0.7%. Boeing CEO Dave Calhoun calling this a tough moment, at least in the near term here for the company, remaining optimistic about Boeing's turnaround plan here. So I think there's some relief when it comes to that cash burn number that we got, $3.9 billion, but it's still $3.9 billion. And you would think that's going to add to some of the urgency here, at least from what analysts have been saying, the initial reaction here, some urgency to that turnaround plan and exactly what that recovery story could look like or should look like here for Boeing in the second half of the year.
And to your point, the playmakers still having their cash balance falling by more than half. That is not going to be good, but it reminds me of the other stock we got to talk about here of Tesla, which is that the street was anticipating such bad news that less bad news is incredible news. And that's what we're seeing play out with Tesla's stock today. We talked with so many guests, Shauna, who said that this is the quarter they wanted show, not tell from Tesla. And then we got a lot of talk, not a lot of fundamentals, and we're still seeing this stock surging, still continuing to go up. We're over 14.5% here in the market trade. They're buying that story rather than the fundamentals, with Musk teasing cheaper EVs as soon as this year, accelerating new models via their existing assembly lines, that overshadowing a lot of bad numbers here. Worse than expected vehicle sales, worse revenue, worse profit, $2.5 billion in cash burn. I want to talk, though, about one potential explanation for this bullishness, which is the idea of this being a future innovation play. And Elon Musk talked about exactly that. Here's what he had to say to investors.
If somebody doesn't believe Tesla's going to solve autonomy, I think they should not be an investor in the company.
Autonomy potentially being the thing that Elon Musk wants investors to be bullish about. Maybe that, and of course, as you've been talking about, Shauna, those cheaper EVs being the things to push the stock today.
Yeah, and I think those two things combined was enough for the Tesla believers to buy into Tesla's longer-term story. That was enough for what they wanted to hear, and that's why we're seeing this pop happen today. Whether or not this move to the upside has staying power, I think that is really what's being debated on the street here this morning, because you're looking at a jump here of nearly 15% to the upside in Tesla shares. Let's talk more about it, because Elon Musk making a lot of promises in Tesla's first quarter earnings call. Those promises, a cheaper EV vehicle, and also the highly anticipated robotaxi. We want to bring in Greg Migliori. He's Autoblog's editor-in-chief, also our very own Press Subramanian, who has closely been following this story for us here at Yahoo Finance. But Greg, let me start with you. Just first, your reaction to what seemed to be enough for those, I keep calling them Tesla believers, but Tesla believers out there. They heard what they wanted to hear, and that's enough to send shares higher this morning. How realistic do you think Tesla's plan is for a cheaper EV, and then also eventually that robotaxi?
Hey, good morning, guys. I think Elon Musk and Tesla said exactly what they had to say after weeks of criticism and taking a lot of heat for this pivot, apparently away from a lower cost vehicle that we think was going to be called the Model 2 to robotaxis. We knew earnings were going to be lackluster by Tesla standards, and combined with the layoffs and all these high profile executives departing, Tesla knew it was taking heat. They had to respond. As far as making like a robotaxi, I think this is potentially the graveyard of where automakers go to maybe not die, but waste a lot of money. Volkswagen, General Motors, Ford, Amazon, you name it. They have tried and maybe not totally failed, but they've faced a very uphill battle. That being said, I think, I wouldn't count Tesla and Elon Musk out. I think when you look at Elon's mindset, he always wants to do what's next. So when you try to crawl inside his brain, making a small, cheap car doesn't really seem like a big play for him. He wants to put the world on autonomous wheels. And I think that's what he's trying to do here.
Right, but that promise that investors are buying, there's not a lot of fundamental there, right? So I want to bring it back to the likelihood of that fundamental dream he's selling coming true. How likely is it that we're going to get a $25,000 car within the next 12 months?
Within the next 12 months, I think I would put it more like 18 months to 2 years. I think there's like automaker time, and then there's Tesla time. I think if this were Toyota or General Motors, they could probably get that vehicle out in about, a normal timeline. I think with Tesla, they usually are about 6 months to a year behind what you would expect from a traditional automaker.
Hey, Greg. So last night also on the call, they talked a lot about the next-gen platform, but that these newer cars would use a mix of next-gen, possibly components, and also the current platform so they can be built on the existing lines. I'm guessing your take is that it must be the only way to get these cars out sooner, right? I mean, everyone needed to see them come out now rather than later.
Yeah, I think Tesla's taken a fair amount of criticism for letting its cars get old. They haven't done very much to update them in the last few years. In this case, I actually think it's probably a pretty smart business strategy. It's pretty common practice in the car business to take parts of outgoing platforms and use the good parts that still work and then redevelop them with something a little bit more advanced for the next generation. So I think that makes sense, especially when you look at Tesla's manufacturing footprint. They're trying to, produce vehicles in China, the United States, and Europe. They need to have some commonality and some simplicity. And I think this gives that to them as far as trying to maintain some level of quality and consistency. Because, they did just lay off thousands of people. So when you do that, you often see quality dips. So I think this is probably a conservative approach, but you've seen it time again in the car business as far as platform redevelopment over years.
Is it going to be enough, though, the long-term play, right? Not even longer term, the next 12 to 18 months, is it going to be enough to reaccelerate the growth that has been missing inside Tesla?
I don't think it will. I think, honestly, it's going to take them a while to get these things out. I think Tesla's in probably for a rough maybe year or so, being a little cynical and skeptical about their prospects. I think they're in a time of transition. I think the Cybertruck hasn't been the home run that they wanted it to be. I mean, obviously, it's being recalled. So there's challenges there. I think the Model 2, if that's what they end up calling it, or the small vehicle, will take time to get out there and then, see if there's a market for it. I think consumers are excited about the fact that it could be a cheaper Tesla, but I don't think they want a Tesla that's below the quality, the premium experience they've come to expect from other models. So I think Tesla could be in for a rough year or so.
Okay, so Greg, pull out the crystal ball for me. Let's say you and I are talking a year from today. What's the headline going to be on Q1 2025 for Tesla?
I think in Q1 2025, it will be another situation where we'll probably see things like Tesla earnings disappoint, as production is slow to ramp up for robotaxis and the Model 2. I think it'll continue to be a time of transition. And then maybe towards the end of next year, that's when some of these things tend to gain traction for Tesla. Tesla is such a boom and bust company that it's usually going well until it isn't, and then vice versa. So I think it's going to take, 18 months for them to get traction. And then, being Tesla, they probably will come out with a couple of strong products and start making, a gargantuan amount of money, and things will be okay with them for a few years.
All right, Greg, we're going to have to leave it there. Actually, Praz, did you have one more question?
Just real quick about China. We had the Beijing Auto Show kicking off today, I believe. A lot of heat there, a lot of big manufacturers and Chinese upstarts there in the EV world. What do you think about Tesla in China? Can they kind of keep their kind of footprint there? Are they going to kind of be still a big player?
I think so. I think Tesla is such a expanded, growing market that it really is a great opportunity for Tesla. They have a factory. The market is growing. The government is providing incentives for EV buyers. And it is the market that has the single greatest acceptance rate of the technology of the world. So China is sort of just a wide open field for Tesla and all EV makers right now.
All right, Greg, we are going to have to leave it there now. Thank you so much for joining us. Really appreciate it. Greg is Autoblog's editor-in-chief. And of course, Pras, thank you so much. And great question on China at the end. I'm glad we got that in there. We're going to continue to cover the earnings momentum that we're getting through Tesla and other tech stocks here higher this morning off of that, fueling a comeback for the S&P and the Nasdaq with earnings season now officially in full focus. We are at a stage where the market is starting to broaden out and become a little bit more stock specific for momentum. At least that's what our next guest is saying. Right here we have Fabiana Fedeli, Chief Investment Officer for M&G's Equity, Multi-Asset, and Sustainability Division. Fabiana, thank you for being here with us this morning. It's so interesting to have you here because in the beginning of the year, it was all about index funds, buying this market rally as broadly as you could. And now you're saying that it might be more of a stock picker's market. Explain.
Good morning. Yes, well, if you look at what happened last year with the market, it was all about the Magnificent Seven. But if you look at what is happening this year, none of those Magnificent Sevens are making it in the top 10 of the world best performing stocks. And their size is so huge that even small outperformance is actually moving the index back with them. And this is what is happening right now. If you're looking year to date and also month to date, the S&P 500 is actually behind some of the largest indices in the world. It's behind the Eurostoxx 50. It's even behind China. So we really need to start looking at stocks on a more stock-by-stock level. And there is a lot of interesting stuff out there.
Where does that leave the Mag 7 names?
Look, some of them still make a lot of sense as investments, but they're just not one block. And you really have to start thinking about it on a stock-by-stock basis. If there's one thing that this earnings season is starting to show, we're very early days, right? But it's showing us exactly the same as the past two early seasons have, which is stocks that are even in the same sector with very similar drivers, they're actually performing very differently. And this is because they have better product innovation, they have better cost control, ultimately they have better management. And you'll see this also among the Magnificent Seven.
So Fabiana, talking a little bit more about that, I'm not asking you to pick specific stocks, but in terms of the trends, I know you're saying you can't just buy the Mag 7, but is it on a valuation basis? Is it what the focus is for the company, certain AI plays? What is it that you're finding maybe more attractive in terms of an opportunity there for investors than others at this point?
Sure. So right now, it's all about expectations. Some valuations are high, but it might have actually expectations that will be met. But if you look at what is happening with the earnings season, and by the way, don't only look at the US, we had some earnings, for example, in India that are telling us something about what is happening with the US tech market. Some of the legacy IT spending is not doing well at all. AI-related IT spending is doing much better. You see this from the earnings calls of Infosys, for example, but also Accenture. So if you are looking at which companies to invest in when they're linked to AI, make sure they don't have a legacy business that is actually bringing them down, because we're at the juncture point where AI might not be able to offset the drawdown of the legacy business.
Well, it's a great point to look global. And I've been thinking about the reaction that we saw to TSMC's earnings. They beat expectations, and then the stock was down 10, 15% that day. And then we have Tesla giving us sort of an empty promise, and they're up over 15% the last time I checked here. So Fabiana, just help me explain the thinking. Like, what thesis am I supposed to take out of that?
You know, this is really not a good time either to be an index investor and no to try to time the market in a short term. Some of the trends are going to be visible on a longer term. The reaction to earnings are really based on expectations, and small twists in those expectations are going to really have outsized movements in the share price. So if you like something, buy it. If you don't like it, stay away, because the fact that there is short-term price momentum is not a guarantee that it's going to last for the rest of the earnings season.
I love this soundbite. Not a good time, Fabiana. I appreciate that. But for our audience of retail investors, what's the single biggest thing that they should be thinking about when they are trying to select what there might be a good area for a little bit of an edge to get into?
Look, think beyond sectors. Think about themes. Think about themes that are going to be around no matter what happens to the economy, no matter what happens to politics for the next 10 years. One of them is infrastructure. You see a lot of capital going in. Governments putting capital in, companies are putting capital in. The other one is innovation. Innovation includes AI, but you had a segment early on talking about innovation in healthcare. And last but not least is energy transition. I mean, the world is changing. The way is dealing with energy, whether we want it or not.
All right, Fabiana, we got to leave it there, but thank you so much for joining us. That was Fabiana Fedeli, Chief Investment Officer for M&G's Equity, Multi-Asset, and Sustainability Division, with a great point there on innovation. I think that's what's driving this Tesla move today. Now, coming up, it has been a rocky start to the year for Apple. So what should investors expect from earnings coming up in early May? We're going to discuss that after the break.
It's been a rocky year so far for Apple, with shares down over 10% since the beginning of the year. You can see that steady decline right here on the screen. Well, the tech giant kicked off January with 3 downgrades. Redburn Atlantic, Piper Sandler, and Barclays all citing fears surrounding iPhone sales. Well, those concerns persisted into March after the Justice Department sued Apple, claiming it's monopolizing the smartphone market. And Apple's China sales have also been a pain point, with data out from IDC and Counterpoint Research research, both pointing to double-digit percentage declines in iPhone sales in the region during the first quarter. So as the problems start to pile up and have piled up for that Mag 7 stock, what can investors expect on earnings May 2nd? Bob O'Donnell is Technalysis research president and chief analyst joining us now. Bob, it's great to have you here in studio. I'm going to join you in just a minute, but talk to us just about Apple, where we stand right now, and whether or not you think earnings next week are going to reassure and give investors back that lost confidence.
Well, Shauna, I mean, look, I think it's going to be tough. I mean, the reality is we've heard about those iPhone numbers in China. We're seeing a general trend towards some challenges in the U.S. market as well for iPhone. You know, and iPhone has once again become a huge part of their business. For a while, obviously, it had declined, and now we've seen it grow again. And so that's a big issue. You know, unfortunately, the Vision Pro doesn't seem like it's exactly killing it. Yes, of course, there was a lot of excitement. You're going to expect that right away. But already you've got fatigue from people who've bought it. Apparently, the interest in the stores has gone way down as well in terms of people coming in to try it. I mean, all of these things are factors we have to look at. Mac sales have been tough. They did just announce an event where they're expected to unveil some new iPads. But, I mean, you know, it's an iPad. Like,
yeah.
Okay.
That's what we've all been saying. It's
Which is why it didn't really react at all to that news much yesterday.
No, exactly. So, I mean, you know, and so these are the issues. And, you know, look, in the past, I've been watching and tracking Apple for a very long time. And they've always been able to pull a rabbit out of the hat somehow. Just like, you know, Musk amazingly pulled something yesterday for Tesla, and here we go. But the thing is, it's starting to pile up now, and it's starting to get a little bit harder, right? Between the iPhone sales, between the geopolitical issues in China, which is still a very big market for them, and now they're having to do a little bit more of what the Chinese government is requesting. Huawei is getting stronger in China. There's nationalistic movements there to try and pull some of the U.S. companies out. You know, the car project was canceled, which I think in the long run was the right thing to do, but you know, it could have been interesting earlier if they kind of figured out a different path. You know, and of course, then Gen AI. What are they doing with Gen AI? That's what everybody wants to know. Now, we do expect that at the WWDC, their developers conference, they will absolutely have some news around what they're doing with Gen AI, both on the iPhone, in the Mac, and perhaps other types of services. And that's going to be important. And again, we've seen services as the driving factor for that business. It's grown as a percentage of the total. It's the most profitable segment, of course. So, but at the end of the day, that services business is tied to the devices. And so if devices stall, at some point, services stall is the logic, right? So we'll see what happens. It's certainly going to be interesting to watch, but I have to say it's a little bit tougher this time around than I think it's been in quite some time.
Well, what is the bigger headwind then for Apple? Is it that headwind from China, or is it some of the lack of churn that we're seeing from U.S. consumers holding on to their iPhones for longer?
Yeah, it's a good question, Maddie. I mean, I think it's a little bit of both, really, you know, because it all plays into it. I think there's psychologically a lot of questions about China because Apple has made such a big deal of China, even if economically it's not quite as big as some of the other areas. So that's why it's kind of hard to put my exact finger on it. But they're all important issues. And, you know, and again, as the company that just kind of led all of us into this tech phenomenon that we've enjoyed over the last several years, it's kind of tough to see this. So, you know, then let's not forget all the stuff in the EU, the Justice Department, as you mentioned. You know, and I think there's some challenges there. And the thing that kind of drives me crazy is that I feel like there's certain things they could do to just appease some of those issues. Like, look, let people set up third-party app stores. Nobody's going to use them anyway, so who cares? Like, you know, there's certain things they could just do that would be, I think, psychologically, philosophically, a right move, but you know they're just a little stubborn in their unwillingness to make some of those kind of changes.
So, Bob, it sounds like you might see a little bit more downside risk than ahead for the stock, given the challenges that are mounting. Is that right?
I mean, look, it's hard to say for sure, but it certainly seems like signs are pointing towards it being a difficult quarter and, you know, not necessarily having a whole lot to count on, again, until WWDC. When that happens and we hear a new strategy for iOS, for macOS, Undoubtedly, there'll be some Gen AI stuff. Maybe they're going to do partnerships with Google, for Gemini, or maybe other companies. All of those things are interesting and could add some spice and vigor back into the stock.
But when it comes to Apple, they're largely viewed right now as lagging behind the AI curve, at least when you compare it to many of the other Mag 7 names. Is that the right way to view Apple at this standpoint?
Absolutely. I mean, it just is. I mean, they have intentionally kind of stayed away from it. Over the last couple of earnings calls, they started to mention it. They're kind of working their way there, and there have been a lot of hints coming that they do indeed have bigger plans for it. So, but they're absolutely much further behind than all the other folks. Now, to be fair, I think they're going to take a different approach. They're going to focus a lot around what things can we do directly on the device. And that's a big picture trend I think we're going to see for other smartphone makers from, Samsung did this, we talked about this with Google, some of the things they're starting to do on their Galaxy phones. Qualcomm's talked a lot about this with the chips that are running in those Samsung phones, and they've got, of course, PCs coming out later this year that are expected to offer some of these capabilities. I'm going to Taiwan for the first time in forever to go to Computex because all these AI PCs are going to be there. So there's a lot of focus around that, and I think Apple's going to think about doing AI on the phone, on the Mac, on the iPad, and they're going to try and come up with the unique Apple angles, which they're incredibly good at, to make it more relevant to average people. And so we're going to, that's going to be a big one to watch and see what happens, because if they can kind of figure out a way to explain this to people in a way that people are like, oh, yeah, I got to have this.
Yeah.
It breathes new life into their products. And it reinvigorates things again. So that could be the rabbit they pull out of the hat.
So for the rabbit out of the hat, we have Tesla doing it. Obviously, great news for them today. We have Meta reporting tonight. Help me tie together the narrative that we might see. Like, if we get a huge surprise from Meta, how high does that raise the bar for Apple, which Tesla already did?
Boy, that's hard to say. I mean, I think advertising seems to be doing reasonably well. I mean, the bigger news that I'm watching from Meta is how they just licensed the OS for their headset to other players. That's going to be really interesting. It's tiny from a monetary perspective. And then, of course, they're doing a lot with their Llama models. They just released Llama 3. There's huge interest in that. And the question is, how do they start to monetize that? I think we'll eventually start to see some interesting new flows of income into the company outside of their traditional, advertising sort of stuff.
So helpful, Bob. Thank you so much for coming
welcome.
in.
Thanks,
this was
guys.
great.
Thank you.
Really appreciate it. Thank you so much. That was Bob O'Donnell, Technalysis Research President and Chief Analyst, joining us in studio. Let's do a check on the market, sponsored by Tasty Trade here. Looking at green across your screen, except for the poor Dow down. Basically unchanged there. You got the S&P up a little over 0.1%, the Nasdaq up a little over 0.5% here. I'm just taking a look at what we're seeing in terms of individual sector movement. No surprise, the IT sector, the best performer in the S&P pie this morning. You're up about 0.8% there. Interestingly, real estate and energy also the only other two sectors that are in the green this morning, the biggest laggard being in industrials on the day. So seeing a little bit of interest rate sensitivity perhaps also kicking into the market. But the big move here, of course, also consumer discretionary, because Tesla plays in a consumer discretionary, is also up almost 1% for the S&P here. We're going to have all of your markets action ahead, so stay tuned right here for more. You're watching Yahoo Finance.
Data measuring the direction of the manufacturing and service sectors came in lower than expected in April. Well, in fact, it was the lowest reading that we've seen in about 4 months. For more on what that says about the state of the U.S. economy, Josh Schaefer is here to answer all those questions. Josh.
Yeah, so we'll start with it's one number and one data point. And yes, it is a little bit of a reversal of a trend, but I wouldn't go too far on one print, right? Specifically because when we take a look at the broader composite index from the S&P, it was actually still above 50, which would mean that economic output is still in expansion. So it wasn't necessarily a total downturn by any means. It was just a cooling off of some of the data that we have seen recently. But you guys spoke with Chris Williamson yesterday, the global chief economist over at S&P, and I thought he had an interesting point on just maybe this is some of the first signs we've seen of higher rates and sort of the higher for longer narrative and companies reacting to that, and maybe economic data coming in a little bit slower than that. Again, it's one data point, so it's hard to look too far into this. I did find it interesting. We had our dip in the 10-year yield yesterday, right as this data was released. It was not a large dip. It was about 5 basis points, but it was a little bit of easing that we saw that came with that. And I think spinning that forward, what my larger question is going into tomorrow when we have the GDP print is just sort of, is good news good news? Is bad news good news? How's the market going to read the economic read tomorrow, and how do we react? Because we've been in a position for a couple months now where it felt like good economic data was read as positive for the market, right? We were worried about a downturn, and we have had positive economic data. That has been good news. Stocks have rallied on that. We've had sort of broadening out rally on strength in the economy. But it feels like we might be getting to a point now where people are a little bit more jittery about that given the inflation data that we've had. So is a too hot print for GDP in the first quarter, which is again backward looking, we should highlight, but is that too hot for the market given the inflation concerns is probably the top thing to watch, I think, going into tomorrow.
So do you think the market was moving, and obviously we have Tesla now, but do you think that the kind of bump that we saw yesterday after PMI, was that because it came in just a little bit soft and that's so exciting that the Fed might be able to cut, or is it, yay, we're in tech earnings, it's gonna go up?
I would probably say yay, we're in tech earnings, and also you had a pretty big drawdown over the last 6 days, right? We went down 5% for the first time in a long time, and I think you just sort of saw some willing buyers come into that dip more so than anything that had to do with eco data. Our head of news, Miles Upland, said yesterday when I was on air with him that if we're moving on something like S&P preliminary PMIs, maybe that's a broader opinion on sort of where we're at in the market and getting a little too jittery, which I thought was a fair take. That was sort of how I felt about when we read too far into maybe one release. But again, maybe a little bit of a sign of some level of a slowdown, which I do think people would probably be okay with because, again, it's still positive.
And that's kind of the pattern that we've seen from the market since really the start of the year and really going back to really the end of 2023. It's hearing what it wants to hear. It's looking for any sort of data point that's going to support that longer term growth narrative. And when they see some weakening there, the fact that that could maybe bring up rate cuts, it seemed at least enough to please investors at the start of the trading day yesterday, shortly after the start.
And this is the point in the conversation where the market strategist tells you should be careful what you wish for, right?
Yeah, exactly.
Because if that gets you closer to one interest rate cut and a 25 basis point interest rate cut, that's not going to matter that much for company balance sheets. People argue it is not really that consequential of a move. If we're arguing between 1 and 2 cuts this year, it doesn't matter that much for a lot of these companies. What does matter is that the economy stays on solid footing, the labor market stays strong, and so companies stay in a solid position. And so I think if you're sort of wondering what to root for from some aspect there, I think a lot of people side with you want the economy to remain strong and the data to keep coming in solid, rather than just getting a little bit closer to that first cut.
Yeah. Josh, thank you so much, as always, for joining us and for your reporting on the economy and markets. Really appreciate it, as always. Investors have experienced sort of a teeter-totter when it comes to rate cut timing expectations. Interest rates are now at a 2-decade-plus high. Back in December, Fed Chair Powell sparking optimism across the street with rhetoric around rate cut timing, but recent commentary has investors dialing back their expectations.
The question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today. We'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence.
Only 36% of traders now pricing in the first rate cut coming in July. This week, we're going to get some more insights, though. We've got two new sets of economic data helping inform the Fed's thinking around monetary policy. We've got GDP out on Thursday and PCE, the Fed's preferred inflation gauge, coming out on Friday. So joining us in studio for more reaction, we have Michael Reed, RBC Capital Markets U.S. economist. Michael, thank you so much for being here in person. We mentioned some of the economic data coming out this week. Which one do you think the Fed is going to be looking at the most closely? I know they always look at supercore PCE, but is there any chance that GDP could be a better indicator this time around?
Yeah, sure. Thanks for having me. So, we're looking at everything. Certainly, spending has been hot. We're looking for services spending to really drive most of the growth in terms of GDP. And I think that's a factor that's playing into the services price pressure that we've seen of late. So they'll be looking at supercore. Also, you have to think about housing and how that factors into PCE. It has a little bit lower weight compared to CPI, but still there's some pressure there, and we've yet to see some relief coming from that component.
So looking out beyond the prints that we're going to get later this week and kind of the trends that we could maybe extract from that for the remainder of at least the first half into the second half of the year, how do you see these prints really setting the stage for maybe some of that growth that's you might expect to remain here for the second half of the year?
Yeah, so we really expect to see the labor market to remain tight. The continued retirement wave that we are seeing is going to put downward pressure on the unemployment rate, and that's really going to put upward pressure on wages. In addition, we do see a risk of slowdown coming from some of the headwinds, in particular federal student loans, but the Biden administration has come out with some new plans that have really kind of curbed our worry there. So looking ahead, we do see a tailwind in particular coming from consumer spending really being driven by the drawdown of retirement assets. And that's a measure that I think we as economists and forecasters have largely missed in this cycle. And that's something that's really creating a tailwind here for the economy.
Does it matter that the majority of the spending, in your view, then is coming from a certain age group of individuals that is driving the growth of the economy? Or is it just if that contribution number is high, we're getting strength?
No, not at all. In fact, it's a very good thing in the sense that you're going to have a larger share of the population that is driving that consumption. And they are no longer tied to the labor market. So, their confidence and their ability to spend is disconnected from their worries about losing a job. And on the flip side, as I said, that their exit from the labor market is going to put downward pressure on the unemployment rate, and that gives more confidence to consumers who do rely on their wage income to continue to spend and continue to pay down the debts that they do have.
But then isn't that bad news for the Fed? And at what point do we get to a position where it would be better, at least for the CEOs that Shauna and I speak with, to hear the Fed just say, we're actually not going to do anything this year, so that people can just kind of plan around an expected outcome?
Yeah, absolutely. I mean, the Fed's in a really tough spot right now. In addition to the election coming up, you have base effects that are going to come into play for PCE, in particular core PCE. So if we continue to see prints on a month-over-month basis that are above 0.2, that's really risking putting upward pressure on that Fed's preferred measure of inflation. If we see something higher, something like 0.25 or even 0.3 on a month-over-month basis, you're now shifting that narrative from no cuts into potentially hiking.
All right, Michael Reed, we would love to have you back. Hopefully, for everyone's sake, we're not talking about hiking potentially here and what that fallout could potentially look like. But Michael Reed, always great to have you. Thanks so much for joining us here on set. RBC Capital Markets, U.S. economist.
Great, thanks for having me.
Keep right here on Yahoo Finance. Snowflake CEO joining Yahoo Finance after the break. We'll be right back.
Snowflake putting the pedal down on all things AI. Let's welcome in Snowflake CEO Sridhar Ramaswamy. Sridhar, good to have you on here. First time on Yahoo Finance. Can I still call you the new CEO? You've been doing this for a few months.
You can. Super excited to be here. Yahoo Finance is an icon, so I'm thrilled for this conversation.
Oh, wow, it's hard to top after a comment like that. But let's start on the news you're delivering to investors today. It is what you call the Open Enterprise AI model. What is that?
Yeah, so AI, as everyone knows, we'll get into a little bit, is poised to revolutionize a lot of what goes on in enterprise software. For a variety of reasons, the simplest of which is, for the first time since computers, basically, we can just use natural language to be able to talk to software. And Snowflake Arctic is what's called a large language model, like ChatGPT, which you have heard of, that is open, meaning anybody can use it, but it's also enterprise grade. It is designed to work very, very well in enterprise-related problems, not consumer problems like medical questions. And what it's going to do is it's going to let us, Snowflake, innovate and build better and better products for our customers. And we are one of the few companies on the planet that's done this. And so we are very excited for this step and what is to come.
So after you roll this out, how does Snowflake make money off it? Does a company come to you and say, hey, I want to use this model, and they build something on top of it?
Snowflake's aspiration, Brian, is to make software, to make all data products and AI easy and simple to use. So what we're going to be doing is we're going to be integrating this model into our managed model offering. It's called Cortex, so that people that can write SQL, for example, can just use this model, and also other follow-up models that we will be releasing. We will also be incorporating it into products like a Copilot, which helps analysts write SQL faster, or this product called Document AI, which is going to let business users get structured information from things like contracts, from documents, for example. Is going to be seamlessly integrated, and that's how it fits into our business model. As we make better products, our consumers will use Snowflake more, and as you know, we are a consumption model. We get paid when our customers use Snowflake and get value from it. So all that part flows seamlessly. It's not a new motion for us to be using Arctic and all of the other things that we are doing in AI.
I've really been covering Snowflake going back to the 2020 IPO, Sridhar, and I went back to your recent annual report, just refreshing myself on what the company is up to and what you may be doing in the months and years ahead. It's a complicated company. And in this new role, I imagine you talk to a lot of investors. When you're on the road with them or you're doing various virtual meetings, what's the biggest misunderstanding you're hearing from folks on all things Snowflake at this juncture?
Snowflake has evolved a lot, but I would actually say it is a simple company in that it is still built on the core of an incredibly strong data foundation. And so we are a data cloud first and foremost. People trust us with their data. But what we have revolutionized is, for example, how companies collaborate with data. People used to be sending FTP files to each other. Super error prone, super annoying process. Now people can exchange data in real time across companies, across clouds, across continents. We make that transparent. But more recently, we've also been both working with customers, but also with partners to build applications on top of data. That is a big unlock for lots of people because, if you share data with somebody, they value it at a certain level. On the other hand, if you deliver a finished product that can do so much more, you can capture so much more value. It's really that three-part, which is powerful data cloud that keeps expanding, keeps doing more stuff, collaboration, and then applications. That's the 1, 2, 3 of Snowflake. And we're at the frontier on all of these areas. AI is interesting because AI is more horizontal. It's poised to change everything from how data is ingested, moved efficiently, to what kind of applications can you write on top of the data. And that's partly the reason why Arctic is such a big moment, because it says we have the capability to truly infuse AI into each layer of Snowflake and make it better, make it more accessible, and ultimately, yes, make more money for Snowflake.
If there was any knock on the company, it's that it was still unclear this year on how many AI-related products Snowflake would release. But what strikes me with this particular one is you developed it, what, in 3 months? I mean, do you
in
see
3
this,
months, start to finish.
That's really amazing speed. Is the message now to investors that Snowflake is really going to pick up the pace on its AI rollouts in the second half of this year?
100%, but this is also where somebody like me that's run large product teams, that has sort of held the pedal to the metal, so to say, for 15 plus years, with the ads team at Google. I really would like to see faster innovation, more of a sense of urgency in the place. After a while, to build a better foundation with which to extend Snowflake, we're seeing the benefits of all of that. So you're going to not only see rapid fire product announcements and deployments, GAs, in AI, but through the rest of what I talked about as well in the data foundation, where we're releasing support for Iceberg, supporting transactional tables, to more stuff being done with collaboration, more applications, more partnerships, is really just an accelerated pace at which stuff is going to get rolled out. AI, I can confidently say we are at the forefront of what people are doing with enterprise AI, and we are going to stay there.
You spent, lastly, Sridhar, you spent a good amount of time at Google. You really touched a lot of parts of their organization, 15 years as a software engineer, among many other things you did there. What did you learn from there that you are applying here right off the get-go at Snowflake?
Never take success for granted. I ran the ads team, possibly the most successful team in business ever. But never on any day did we say okay, job done. There was always that sense of urgency. The world was changing, whether it was, other competitors in ads or ecosystem changes like, how cookies disappeared, or how mobile came to be. Mobile was an existential threat for Google because we just didn't make as much money on mobile compared to desktop. We got through all of that because of that sense of urgency, the need to seize opportunity. I would say that is easily from day one my thing that I stress with Snowflake, which is we are a wonderful, successful company, but we really have to keep innovating for us to stay successful. That resonates. People want that. People have that hunger to do more. And honestly, even a month in, I can feel the change in how the team thinks about these things and the pace with which we are launching things.
Well, we are looking forward here at Yahoo Finance to follow your CEO journey and a lot of things you bring to market. Snowflake CEO Sridhar Ramaswamy, good to see you, and we'll talk to you soon.
Thank you, Brian.
All right, much more ahead on Yahoo Finance. Do stick around.
Humana shares in the red, down almost 4.5%, falling from earlier highs after mixed earnings results, reporting earnings beating EPS and revenue expectations. But the insurance company then backing off its downsized forecast for 2025 and having some other potentially negative news in that print. For more on this, we have Yahoo finance reporter Anjali Kamlani. Anjali, what's going on?
Yeah, Maddie, Humana is an interesting story. They did good on revenues. They managed to hold out despite the impact from the Change Healthcare cyber attack. But there's so many other things that are pressuring them, including higher than expected utilization on their Medicare side, in addition to lowered payouts and reimbursements from Medicare. So that's really putting pressure on the company and its outlook for the year. We know that they were one of the companies that were impacted by the United Health cyber attack on Change Healthcare because it works with the economic pipeline of the health industry. Meanwhile, looking at what the outlook is, the company hasn't had a lot going for it. It's been under pressure a lot, and you can see that in the utilization for overall what its benefits ratio is, which is the amount of dollars coming in for premiums and spending out. They've increased it compared to the first quarter of last year, reaching almost 90%. And if you recall, insurers like to stay on the lower end of 80 or mid 80s. They're well above that. And that's been the story for some time for the company, which is why there have been so many rumors about a potential merger. We saw that a while back with Cigna. And one analyst in particular pointing out that it might be time to reignite those conversations based on where Humana sits right now. That's Jefferies analyst saying that there might be time for the fusion of Cigna and Humana now that the numbers could make a little bit more sense. So that's one thing to take a look at. Meanwhile, we also know that the company, hasn't had as much going on with their bottom line. So that's another area, that they look at. The JPM analyst, Lisa Gill, also noted that because of the increased utilization last quarter, that's something that was balanced out by a slowdown in March, but we don't know what the rest of the year is going to look like. So lots of factors putting pressure on this company.
All right, we certainly will keep Humana as a stock to watch here, but at least for today, we are looking at gains here as the stock moves to the upside. Anj, thanks so much. Let's do a final check of the markets 90 minutes into the trading day. We're looking at a different picture than where we started the trading session. The S&P now trading below the flat line. You've got the Nasdaq, though, holding on to gains, but off the highs of the session. Some of that relief rally fading just a bit here 90 minutes into the trading day. The Dow now off 83.
And coming up, our new show, Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. He'll be breaking down what a possible TikTok ban could mean for your use of the app. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and those tricks that you need to grow your money. On today's show, President Biden's new rules for airlines and how they may affect you. And the FTC votes to ban non-compete agreements. We'll dig into the impact on the workforce. Plus, defensive plays for your portfolio. We're going to reveal some of those names and themes. But first, we're about 90 minutes into the trading day. Let's take a look at some of the market action here as we're taking a look at stocks in the green, propped up by more earnings reports here. You're taking a look at the U.S. major averages. The Dow right now is down by about 0.25%. The S&P 500 has slipped into negative territory, flat just barely to the downside right now. The Nasdaq Composite, though, holding on to gains of about 0.3%. And Tesla, you can thank that one. It's lifting the tech-heavy Nasdaq higher. Results missing Wall Street estimates there, but ultimately the stock surging after CEO Elon Musk says affordable EVs are coming in 2025. The more cost-sensitive option is teased amid an industry-wide slowdown for electric vehicles. An Oppenheimer analyst telling Yahoo Finance earlier this morning, Tesla is a growth stock that has stopped growing. We're also watching shares of Boeing. The airplane manufacturer blew through $3.9 billion in cash in the first quarter. This was less dramatic than analyst expectations of as much as $4.5 billion. There's a long road of recovery ahead. Boeing's CEO saying the Q1 results reflect immediate actions taken to slow 737 production. And consumers may end up paying the price for Boeing's slowdown in deliveries this year. Shares right now fractionally higher by about 0.8%. Well, TikTok users, listen up, because you may need to find a different way to share your posts and watch your favorite content creators. President Biden expected to sign a TikTok divestment bill today that could lead to a ban of the app. For more on this, let's bring in Yahoo Finance's Alexis Keenan joining us. Alexis, what does this mean for users going forward?
Well, in the immediate future, really nothing, but this is kind of a big deal, right? You have the fate in the hands of really the U.S. Circuit Court of Appeals for the D.C. Circuit. That's where TikTok's challenges would end up initially, maybe even the Supreme Court. But right now, there are 6 months to play with where nothing will change. That's the time frame, the initial time frame that the U.S. government has given in this divest or ban law that has now been okayed by both houses of Congress and is awaiting the president's signature. Now, TikTok has vowed to sue. They say they will bring this into court. And the first thing we would expect is they would ask for an injunction, asking the court for emergency relief to say this law should not go into effect, not in 6 months, not ever. They have been tasked with having to divest to a U.S. entity or face this ban. So in the event that the company does divest, then that wouldn't be a problem, right? In the hands of a U.S. entity, all is well. So then in theory, TikTok and its app could keep being used as it is now.
Interesting. While we have you, Alexis, there's something else, and we got to shift gears because we also got some big news from the FTC announcing Tuesday that companies will no longer be able to prevent employees from leaving to work for competitors. Now, this could shift the landscape significantly for some of the most valued skill sets in certain industries, even rupture the no-call list agreements between tech companies. We've seen some of those famed and viral emails between Adobe and of course, in the past, Steve Jobs at the time.
Right,
So what does this mean here?
So this is really a foundational shift in U.S. law. This is inundating my email box with lawyers trying to work their way through these 500 pages of this rule. Wow. Now, the FTC has said that all non-competes will be banned. It's very sweeping. There are some exceptions, but they're really narrow. Now, companies, once this rule is published in the Federal Register, which could be as soon as today, companies will have 120 days to comply. But what's going to happen is the business community, some of the business community, they're going to object. They're too going to ask for an injunction. They're going to say that the FTC does not have the authority to pass this kind of rule. Now, let's talk about the exceptions very briefly here. One is the main one. That's for business executives who earn $152,000 per year or more. But those that are not okay going forward. That's just the retroactive part. Also, an exception for companies that are engaging in the sale of a business. Basically, you can't enter into a sham sale in order to obtain non-compete agreements. Also, an exception in some sectors, in banking, in stockyard industry, as well as some nonprofits not covered by the rule. But what is going to happen is there are going to be objections. There are already 2 federal lawsuits filed. One comes from, expectedly, the Chamber of Commerce. Another comes from a professional services firm, both filed in federal courts in Texas, and they're going to push back. So whether or not in the end the FTC will be able to go forward with this very broad-based saying no non-competes across the U.S., that has yet to be seen.
Alexis, thanks so much for breaking this down for us, and Godspeed to your inbox as well here. Because my goodness, I can't imagine right now. Thanks so much. Well, where are you getting your retirement advice from? Big question here. Well, certified professionals with the knowledge and skill set to help you meet your financial goals. They're also facing a rising tide of FinTalk and Finstagram content. And then there's also the Department of Labor, which can send you a lifeline. The Biden administration announcing a new rule on Tuesday to protect millions of Americans' retirement savings by cracking down on bad retirement advice. Our next guest says that these rules will put more money in the pockets of workers and retirees. For more, I'm joined now by Ali Kawar, who is the U.S. Labor Department Principal Deputy Assistant Secretary for Employment Benefits Security. Let's dive into this a little bit more. Ali, thanks so much for taking the time. As you think about where this is really expected to make a dent and where this was stemming from, where are you seeing the proliferance of bad advice come forward? Is it social media? Is it some of the faulty financial advisors out there? Where is it?
Yeah, thanks for having me, Brad. I mean, this is a really complicated area. Anybody, myself, try and save for retirement. It's not an easy thing to do, to carve out that time out of your day, figure out what it is you need to save, what you need to invest in, because we're not in the universe of the old traditional defined benefit pension plans. Now people have things like 401ks or IRAs. They need to make a lot of decisions, and it can be daunting. So one of the things that naturally people do and that we want to encourage is that they try and find a professional to help them figure out what the right answers are. The problem that we had is that until this rule came out, the standards that apply to that advice that you get meant that you could be promised up front that you would be taken care of, that your interests would be put first. But that wasn't, as a technical matter, the legal standard that applied. So you got the advice, you acted on the advice, and then if something went wrong, the advisors had the ability to not essentially be accountable, because they could say, well, I wasn't required to give you advice that was in your best interest as a legal matter. I may have said I was going to do that, but that doesn't really matter.
And so what is the dollar figure? What type of delta is this expected to ultimately kind of provide for those who are saving for retirement, for those who are just financially planning?
Yeah, so the White House's Council of Economic Advisors looked at this problem a few months ago, and what they found is that just looking at one particular kind of financial product called a fixed indexed annuity, that could cost investors up to $5 billion a year.
And so all these things considered, wasn't there a fiduciary duty that advisors carried before anyway? And so what's the difference between what was passed in the framework for how they were supposed to be operating versus now what the administration is putting forward?
Yeah, so it gets a bit complicated, and that's exactly part of the problem that we're trying to solve. So we are one of the primary regulators in this area, but depending on what kind of financial product you're getting advice about, there may be any number of other regulators. The SEC a few years ago took some major steps in this direction. And what we're doing is aligning with that, because the SEC doesn't have jurisdiction over all of the financial products that are available in the marketplace. I mean, you might buy real estate, for example, and if that's outside a REIT, it's not a security. It's not something that the SEC has jurisdiction over. Also, importantly, there are insurance products that you can buy. And those insurance products generally are not regulated by the SEC either. So when we looked at the landscape, we saw a problem, because if you're thinking about a retail customer, it depends, who you're talking to, whether they're regulated by the insurance regulators, the securities regulators, what state you're in, because the insurance regulation is not uniform. It varies from state to state. what financial product you're getting advice about. It might be insurance, security, or other. And what we've done is essentially establish a level playing field. So consumers don't have to suddenly gain this expertise, not just in figuring out how to save for retirement, but in what the regulatory regime is and what legal standards apply, because they're actually pretty different prior to this rule.
What would the administration be advising Americans who are trying to figure out whether or not they have a good or a bad financial advisor, and what's kind of that barometer that they should use as kind of a rule of thumb?
So I think one very easy thing to do is ask your advisor whether they are acting as a fiduciary and get that in writing.
Get that in writing and then do what with that?
So being a fiduciary it's a legal term of art, and that carries certain obligations with it. And if someone is willing to make that commitment to you, that means that they're putting your best interests first. It means that they're looking out for your interests when they're making recommendations. It means that the recommendations they're going to make are going to be reasonable, that they're not overcharging you, that they're not lying to you. All of those kinds of things are the consequences of someone saying that they're a fiduciary. But for your average consumer, again, I mean, part of what we're trying to do is simplify this very complicated process for people. So if they just get that commitment in writing, there are untold positive impacts of that.
And, you know, as we're just sitting here talking about the employee benefits and also with the goal of retirement, from the administration's purview, how have you viewed the moving of perhaps the goal line for retirement? Where does that actually sit right now?
Yeah, I think for a lot of people, retirement is within reach. They've managed to save a lot through their workplace retirement plans or otherwise. What we have been doing over a number of years, and there was a piece of legislation passed recently that is going to make another step in this direction, is to make sure that retirement savings opportunities through workplace plans are available as broadly as possible. So going forward, in about a year, all new workplace plans are going to require what's called automatic enrollment. Again, I mean, one of the points I've made a couple of times is that this is very complicated. And what happens sometimes with complicated concepts is it becomes easier to think about it tomorrow and not today. Unfortunately, time isn't on your side when you're planning for your retirement. And the earlier you start saving, the better off you'll be. And so one really important initiative is to make sure that things like 401ks are available to as many Americans as possible. Right now, that's just not the case, and we're hoping to make significant strides in that direction.
Ali Kawar, who is the Principal Deputy Assistant Secretary for Employee Benefits Security. Thanks so much for taking the time here with us today.
Thanks, Brad.
Certainly. Well, President Biden has signed the TikTok divest or ban bill just moments ago. The bill is a part of a larger foreign aid package for Ukraine and Israel that effectively gives ByteDance until January 2025 to find a new American owner or have its app banned from the country, leaving companies who rely on the platform for marketing in a tough spot until the future becomes a little bit more clear. With a clear line into how companies are marketing, Front Row is a full-service e-commerce partner with some of the biggest companies as clients. And to break down what the bill means for businesses, we've got Yuri Boykiv, Front Row CEO, here with us in studio. Yuri, thanks so much for taking the time here with us today.
My pleasure.
Bill just signed. What does this do in terms of shifting the mindset for companies that you work with?
It's interesting because this bill has been in discussion for quite some time, and obviously a lot of our clients who rely on TikTok as the source of referrals, but also as a source of marketing, have been trying to adapt to this new reality. So this is nothing new. We sort of expected this to happen, and most of the companies consider this as business as usual. So it hasn't been a lot of discussions beyond, all right, we operate in as usual. If anything changes in the future, we'll adapt accordingly.
I'm keeping tabs on Meta, of course, a company that could be a net beneficiary if a lot of those ad dollars or even time spent on platform shifts to one of their products or to some other content creation and user-generated content type of product, thinking mostly social media companies here. And Meta set to report their earnings after the bell today. Notably thinking about where some of your business customers are also kind of looking at their alternatives. Where are those alternatives right now?
Yeah, there are a lot of alternatives. At the moment, TikTok is a dominant player for attention, predominantly for Generation Z and Generation Alpha. If you think about the monthly user base, it's about, on average, 1 million users per month. 100,000 of those are influencers. So 1 out of 10 users are influencers. And those influencers are driving a lot of demand for the products that are eventually sold somewhere, either on the direct-to-consumer website, in-store, or oftentimes also on Amazon. The idea that TikTok will be banned fully has not really registered yet, in my opinion, in marketers' mind. But even if it happens, because Instagram and Facebook, which is Meta essentially, adapted to the vertical format of video, the idea is a lot of those same users and influencers will move to Facebook and Instagram. So it is not obviously something that everybody has really figured out what to do with this, but generally that's the hope.
You know, it's remarkable as well. It makes us think about if there is a potential suitor to purchase TikTok from ByteDance, and who would be the most favorable suitor then as well, in order for it to operate as it does now and not lose any of the user experience that so many who spend time on it every day have come to expect as well.
Totally. I think indirectly, it's hard to predict who's going to buy it, if there is somebody who will buy it, but indirectly Amazon will benefit a lot, because as you can imagine, Facebook Facebook or Meta have made a deal to drive a lot of potential sales to Amazon. For the conversion cycle. So if there is a content of influencer on Facebook, they haven't really done anything about it, but they announced there are rumors that it's happening. So the actual conversion will happen on Amazon. So if there is a lot of users moving to Meta, Amazon might benefit from the sale.
Just lastly, we only have 30 seconds. Does this dramatically shift the landscape for influencer marketing as well?
Most influencers operate between the platforms already. Okay. They might have a little bit more attention on one or the other.
All right. Yuri, thanks so much for taking the time here today. Yuri Boykiv, Front Row CEO. Appreciate it.
Thank you.
Thank you. Coming up, Tesla jumping today after reporting its first quarter results. We dive into what the report means for retail investors next. Just under 2 hours into the trading session, let's take a look at the markets sponsored by Tasty Trade. The Dow and the S&P 500 have slipped into negative territory. The S&P 500 down a little more over 0.25% right now. The Dow down fractionally by 0.4%. The Nasdaq Composite, the one bright spot right now, flat, just barely to the upside. We'll see if it could cling on to those gains right now, up by 0.04% and slipping. Well, Tesla out with first quarter results, clocking its first revenue drop in 4 years. The EV maker reported both a revenue and earnings miss, but the stock is soaring today after the company said it would accelerate the launch of more affordable vehicles. Despite today's pop, the stock right now down over 30% this year. And it's becoming popular in the options market. Tesla's short interest is up 30% from the beginning of the year. Here with more, we've got Kevin Paffrath, who is known as well as the popular YouTuber Meet Kevin, and a long-standing Tesla retail shareholder as well. If my memory serves me correctly, as of this morning, you've also trimmed your position recently. Take us into that decision-making, Kevin.
Yeah, absolutely. Thank you so much for having me, by the way. So what I did before earnings and before we got our Q1 deliveries numbers is I thought this would be a perfect time to tax loss harvest some of those higher acquisitions of Tesla shares. So I sold down in March up to the earnings, which we just had yesterday. And so now the debate is it time to rebuy Tesla? And I think investors should be looking at 3 good things that we heard from Tesla and 5 bad. And I'll keep it short. I'll go through them quickly. Margins up in the face of price cuts. Amazing. Even with credits removed, this was a really good positive shocker. They've clearly got efficiency in manufacturing, and that's the reason you want to invest in Tesla. Big fan of that. So we like that good. We got a very hope-filled Elon, which was also very good, and we have the hope of new vehicle models coming. Whether we actually get new models or they're just refreshes, we'll see. But there was some bad, and so we kind of have to weigh the good and the bad here. One, we just added basically 9 lifts to our valuation. The ride-hailing company Lyft, we added 9 of them to our valuation overnight. So I think we might be adding a little too much hope there. We've got the risk of the share comp plan for Elon Musk. Is he going to get paid? If he doesn't get paid, is he going to end up taking the Optimus robot, the humanoid robot, somewhere else? We've got the negative cash flow risk with the AI investments. That's why we're no longer building new gigafactories. Giga Mexico is basically on hold. And we basically just took away the hope that the 4680 battery cells are truly the next greatest innovation, which is the same thing Elon did with Dojo. That, hey, we're doing our own servers, but now we're going to use NVIDIA chips. Hey, we're doing our own batteries. We're just going to use cheaper Chinese chips. So there are pros and cons here, and I'm sitting here wondering, is it time to rebuy? And I just haven't figured it out yet.
Is a more affordable, soon-to-be announced or unveiled or uncloaked vehicle that they talked about on the earnings call, is that a pro or a con in your perspective?
It's a pro if we can actually get a new model, but they purposefully dodged that answer in the earnings call, leaving the door open to the possibility that more efficient vehicles are just versions of the Model 3 and Y that are manufactured in a different way. So for example, a steer-by-wire on a Model 3 or Y, or using a 48-volt architecture to sort of bring down some of those costs without actually introducing a new model. And so investors sort of have to evaluate, okay, are we going to get new models that are going to get us to vehicle growth, or do we just forget vehicle growth for a moment and just hope that full self-driving is actually going to produce the revenue we think it might? Keep in mind, right now we've got a take rate of about 10%. It'd be nice to see that around 20, 30%. But will the cost of FSD come down to offset some of those gains? Those are some of the other things to value. Now, I just want to be clear. I love full self-driving, and I think in the future, everybody's going to use full self-driving, but we might be a few years away from robotaxi. So pricing that in, also hard. And that's why when I look, I go, oh, wow, up 12%. It's still lower than where I sold my shares. I sold some shares between about 171, 175. So I could still buy in at a discount, but I'm sitting here wondering, are we really that close to full self-driving yet to start pricing this in? In other words, full autonomy? I'm not convinced of that yet.
What's the dial mover that would tell you it's time to get back into the name?
I think we've got all of 2024 to set an EPS floor, and so there's plenty of time to buy, in my opinion. And then the dial mover is vehicle growth again, where we actually get back to going from 1.8 million vehicles to 2.5 to 3 to 3.5 to 4, 5 million vehicles. That's the growth we need, because the more vehicles we get on the road, the more Tesla can make from full self-driving, the more data we have to increase that moat for robotaxis, the more potential robotaxis we can have on the road, the more cash flow, positive cash flow they have with good margins to invest in other initiatives like the Optimus. My concern is with this negative cash flow we're facing now, we're really cutting out other initiatives. And I suspect that a lot of them are going to take the back burner. They're suggesting that they're starting production of the factory to build the semi-truck. But they've said that for 5 years. And they showed us a picture of a graded lot. But as someone from a real estate world, I know that we grade lots just to keep the weeds in the city away. So I have a lot of skepticisms and I have a lot of hope. I'm just not sure how much I could value that hope at right now.
Hey, Kevin, just lastly, while we have you, and I would have loved to ask a question about the Cybertruck, I actually need to pivot here because of some breaking news that came out during this hour from the Biden administration that may influence you or many of your colleagues as well in the kind of influencer and content creator category also, where there's going to be more of the perhaps onus on a potential buyer to come forward and buy TikTok, or else it will not be allowed to exist here in the U.S. and a U.S. owner specifically, I should mention as well. What do you think that does for a lot of the content creators like yourselves, and where do you shift to if not on TikTok?
I would be surprised if somebody didn't come around to buy it, because quite frankly, if TikTok was going to get 100% shut down, you could take the value of TikTok in America and just set it to 0. So anything above 0 is going to be a win for ByteDance. And quite frankly, I'm sure they have plenty of friends with American passports who could buy this company and pretend to be different. Do I really think it'll become truly, fully independent? Probably not. Will it get bought up? Very likely. As a creator, it's definitely an uncertain time, because there's always that chance that it's completely gone and removed from the App Store. And even just a period of time, this is the biggest risk. Even if it just disappears for a few months, as soon as people get the routine of using that kind of platform out of their habit of opening their phone every time they go to the bathroom or they're in the kitchen to get a coffee or whatever, as soon as that routine turns into, okay, now they're on YouTube Shorts or they're on Instagram or something else, that definitely hurts creators on TikTok. So the worst case scenario, I don't think, is that they're gone forever. It's just that if they're gone for a window, that unwinds people's habits, and that's the worst thing that could happen.
Kevin, really insightful. Thanks so much for the time. Really appreciate it. Kevin Pathrath, who you can catch on YouTube. Meet Kevin, of course, and financial analyst. Appreciate it.
Thanks for having me.
Let's switch gears. Talk a little shares of Boeing, ticker symbol BA, reversing some earlier gains after the company reported Q1 results. The report closely watched as it comes just a few months after a door plug blowout on an Alaska Airlines Boeing 737 MAX 9 jet. The airplane manufacturer blew through $3.9 billion in cash in the first quarter. This was less dramatic than analysts' expectations of as much as $4.5 billion. Manufacturers saying that these results reflect lower commercial delivery volume. So for much more on the results and how air travelers will be affected, we've got Yahoo Finance's Shauna Smith. Hey, Shauna.
Hey there, Brad. Well, it's all about that delivery number that you just mentioned, and that's really going to trickle down to the consumer, because a drop in deliveries, well, means that airlines, they might be left scrambling to meet that demand, and fewer flights could translate into higher ticket prices, and you could be paying more for your next trip. So let's break all of this down. When it comes to what we just heard from Boeing, Boeing delivered 83 planes here their most recent quarter. Now that's down about 36% from the numbers that we saw a year ago. And drilling down further into that 737 line, well, deliveries there plunging 40% on a year-over-year basis. When the company's earnings release here, Boeing CEO Dave Calhoun writing, quote, "Our first quarter results reflect the immediate actions that we've taken to slow down 737 production to drive improvements in quality." Well, United, Alaska Air, and Delta all mentioning the impact of Boeing's delayed deliveries in their most recent earnings results. United now expects a total of just 61 narrow-body aircraft deliveries this year. That's down more than 30% from their initial projections of 101 here to start the year. And Alaska Air now expects to receive between 10 and 20 Boeing planes, down from its initial expectation of 23. And Delta CEO Ed Bastian, well, he told investors investors last month that he expects 737 MAX 10 jet deliveries to actually be pushed out to as late as 2027. So you have a number of those big airline executives warning about a drop in deliveries, and that results in reduced flight capacity, all of which could affect pricing, especially this summer when we are expecting to see yet another record-setting travel season. Well, we talked to Morningstar's Nick Owens recently, and he weighed in about the prospect of higher prices for consumers as a result of deliveries. Let's take a listen.
It will be, I think, another year and a half before Boeing gets a go-ahead to produce some more 737s. And so I think you'll see a kind of plane shortage story unwinding. So they'll be using older planes a little bit longer and so on and so forth. And just generally not being able to grow the capacity quite as fast as they had originally hoped. You saw some talk in the announcement here about reshuffling their order book and so on, and other airlines are doing that too. Right. So what I'm driving at is slightly less growth in capacity, and as long as we still have this resurgent post-COVID travel demand, that just means prices will go up.
So let's take a look at where airfare prices are today, because the latest inflation data is showing that airline fares have at least fallen on a month-over-month basis, drop of 0.4% on a year-over-year basis, or actually off 7%. But when we talk about some of that relief that we have seen, well, it might be short-lived if some of those projections from analysts like Nick Owens come true here. And Brad, when you and I were speaking with him last week, he was saying that $250, it's now the new $400, right? You have to be ready to pay $400 if you're going on what had cost you $250 not too long ago. That's going to be a tough pill to swallow here for many of Americans who are looking to get out and travel. But if they have to pay that much more for airfare, then that clearly can be problematic this travel season.
Yeah, that's where Avis, Hertz, Enterprise, and AAA would say, well, you could just drive if you want to. Of course, that's always their reminder. Shauna, thanks so much for breaking this down, all things airfare. Coming up, everyone, what ETFs should you consider in a volatile market? We get the answers next. Well, earnings season can certainly throw markets for a loop from time to time with some volatility anticipated. And we're exploring what ETFs might be right for you against and amidst some of that market volatility. To break it down for us, Jared Woodard, who is the Bank of America head of the Research Investment Committee and head of ETF strategy, joins us as part of our ETF report brought to you by Invesco QQQ. Great to have you here with us. First and foremost, amid earnings season, even today, we're watching the market activity and major averages kind of flip-flop here amid earnings season. And so for those who are trying to best stomach that volatility and look to ETFs, where are some of the potential plays that are evident?
Thanks for having me. You know, one of the reasons that we cover ETFs and think that they're such a useful product in markets like this one is that ETFs, exchange-traded funds, after all, are just a basket of assets, stocks, bonds, commodities, whatever it might be. And in the midst of earnings season or amid other sources of volatility, geopolitical risk, et cetera, ETFs can be a nice asset to hold in a portfolio when you don't want to take a really strong view on a particular slice of the market. So right now, for example, we see a lot of investors will own an ETF tracking a particular industry or sector if they want to avoid some of the volatility that's associated with individual equities as they report earnings and you see a pop or a drop in the stock accordingly. In the case of broader macro conditions, which is where we see a really profound shift toward ETFs among investors of all types, we're thinking more about longer term risks of volatility, higher interest rates, possible rate cuts later on this year or next year. And that's where I think different groups of ETFs can really shine in a portfolio.
Jared, you mentioned that there's some sectors that investors may tend to lean towards with their ETF decision making or allocation. What are some of the biggest and top themes that you're seeing remain strong?
Well, right now there's a great shift in the investment community toward the potential for interest rates remaining higher, for longer than they had anticipated earlier this year. If that's the case, and if that macro environment continues into coming months and quarters, we see great potential in lending parts of the market and taking credit risk in the market. So that includes assets like loans. We like collateralized loan obligations. JAAA is a great example of a fund we cover in that market. Preferreds can give you a nice source of yield. So PFF is an ETF that we cover. These parts of the credit market, maybe a little bit away from conventional fixed income, can provide an income stream with less exposure to potentially higher interest rates for a longer period of time that might prove difficult for conventional assets like government bonds or investment-grade corporate bonds.
I wonder, as we've been tracking gold over the past several weeks here and seeing some of the new highs that have been notched and now kind of moved off of just a little bit, where that's presenting at least a thread or some type of mindset for commodities-related ETFs, or just specifically even looking at gold?
Yeah, we think commodities are an incredibly important part of a portfolio, real assets generally speaking, that most investors haven't owned in significant share in recent history. That's changing. We see that right now with the movement in the gold market that you mentioned. IAUM is a fund that we like to own gold. And the reason that we like gold is precisely because of how unusually it's acting compared to history. Gold is a great hedge for portfolios, has a very low correlation to stocks and bonds, but it's also been a big beneficiary of central bank buying in recent years on orders that you've never seen before. This is without precedent in the history of the last several decades at least, with massive buying of central banks, and actually investor participation has been a bit light, which means we think there could be further upside in the price, and ETFs that own gold could be big beneficiaries.
Jared Woodard, who is the Bank of America head of the Research Investment Committee and head of ETF strategy. Jared, thanks so much for taking the time here today.
My pleasure.
Well, coming up, everyone, we dive into the new home market with our very own Danny Romero, live from a freshly built Toll Brothers property in Long Island. Oh my gosh, that's like deep Brooklyn, right? That's part of our week-long special, Real Estate, the New Reality. We talked to her on the other side of the break.
Realtors across America may be getting a massive pay cut. The National Association of Realtors agreed to pay $418 million to help compensate home sellers across the U.S. as part of a groundbreaking settlement. Compass, Keller Williams, and RE/MAX have settled claims as well. Multiple lawsuits argue that brokerages conspired to boost agents' commissions and indirectly inflated home prices. The agreement effectively will destroy the current home buying and selling business model. This settlement comes after a federal jury ordered the NAR to pay damages of $1.8 billion for similar allegations back in October. So what does this mean for buyers, sellers, and the housing market at large? If approved by a federal judge, the standard 6% commission that real estate brokers have received will likely disappear. And 2, buyer broker compensation is no longer allowed to be included on local centralized listing portals, known as the multiple listing services. Some analysts on Wall Street think that these new rules will lead to commissions falling by 25 to 50%. The Wall Street Journal reported this change could drive hundreds of thousands of agents out of the industry. Home sellers should now be able to negotiate fees with their agents more easily, and buyers, who may now have to pay their own agents, may forego one or opt for fewer services. Of course, with lower commissions, many are hoping we could see home prices fall as well. We cover all of this and more on Yahoo Finance's Real Estate, the New Reality.
New home sales surged in March, up 8.8% as buyers turned to those turnkey properties amid a persistent shortage of pre-owned homes. High mortgage rates are keeping current homeowners locked into their properties and low rates. So, what are the options out there for those ready to buy right now? Our very own Danny Romero is live. She is ready to buy too from a building and this property in Long Island as part of our week-long special Real Estate, the New Reality. Danny, what can you tell us about this? I mean, beautiful staircase, by the way.
Brad, it's open house at this Toll Brothers community in Dix Hills on Long Island, New York. This community was opened fall of 2022. There are about 30 homes specifically in this community, and the starting price tag for a home similar to this or down the block is about $2 million. Now, it does take about a year to build out a home like this, and the home lots on average are about 1 acre, but a home itself is about 4,000 square feet to 5,200 square feet. Again, there are about 10 to 12 homes still available, and there's actually one home that is move-in ready, and you can move in as early as September of this year. Now, of course, these homes, these beautiful luxury homes, offer a plethora of amenities. Some of those include a basement, a stunning outdoor living feature like a pool. And most of these homes have about 4 to 6 bedrooms or 2.5 to 5 bathrooms, Brad.
And so what kind of incentives are they offering? I mean, we're taking a look at some of the features here that you were running through, but what are the incentives?
Toll Brothers customizes their incentives to their buyer. And the popular incentive across all home builders has been the mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan. And for example, for Toll Brothers, they are currently offering a mortgage rate of 5.8% for their move-in readies, but that's not really applicable for this community specifically in Dix Hills. But the CEO did say on their first quarter earnings call that the majority of their buyers do qualify for the average market rate of a mortgage rate. So they're not really using the buy downs. Instead, they're using those incentives to help lower closing costs and to use some of that money for upgrades and amenities, Brad.
Wow, that home just screams restoration hardware. Danny Romero, thanks so much for taking the time here with us today. Appreciate it. Well, the Biden administration announcing new rules for airlines, requiring airlines to be more transparent about extra fees and to issue cash refunds automatically in some cases. These new rules come after more than a year of promises from the administration to give more protections to air travelers. So what does this mean for you, the air traveler, ahead of peak travel season? Big question, and a good one. Well, if an airline cancels your flight, you are entitled to a full cash refund automatically. Same goes for if your flight is significantly changed or if your baggage is really delayed in getting back to you. Also, if you aren't provided Wi-Fi but you paid for it, full cash refund automatically. Moving to the next rule. No more surprise fees. Airlines will be required to disclose checked baggage, flight change, and cancellation fees upfront. And airlines will have to disclose the true cost of flights, including carrier-imposed fees. So the fee that you see advertised is pretty much the price you pay. Same goes for third-party booking sites. They're also required to be transparent about the fees. All of these rules should help you on your travels heading into that busy travel season. Well, coming up, we discuss how to get defensive in the market. That's next. Markets have been regaining some of their losses over the past few days. We're waffling here today, though. Investors still saying defensive. Critical readings on the economic growth and inflation are trickling out over the next few days, and that could put an end to some of this momentum that we've been tracking. So for more on staying defensive in times of uncertainty, we've got Michael Gayed, who is the Title Financial Group portfolio manager and publisher of the Lead Lag Report. Great to have you back in studio.
Yeah, no, I appreciate the invite, sure.
Absolutely. So let's talk about this. I mean, because even today we're seeing some waffling in the markets and a lot of investors out there perhaps wondering what does it mean to be defensive in an environment like this where you've got economic data, and then you've also got earnings, which are going to send things teetering a little bit.
Well, I always say that path matters more than prediction because people respond off of path behavior. And I think there's this idea out there that playing defense means you either sell or you short equities. I have a problem with that. A lot of studies show that that doesn't work. Market timing doesn't work. I think the proper way to think about what defense means is how do you lower exposure to the factor which is likely to be most volatile? So defense is more about lowering your volatility profile as opposed to trying to make a directional bet.
And so with that in mind, what is the best way, especially amid a time where you're going to hear a lot of chatter either from the Fed speak that we heard last week or from CEOs over the course of the earnings season, where you can stay invested and still stay defensive at the same time?
Yeah, so if you go with that framework that it's around volatility, right, then the question is what tends to benefit from volatility in equities? Now, the reality is, look, most things are tied to equities, meaning most things are variations of beta. So if you're going to try to play defense while still being long only, which is really the only way to be defensive in my view, there's really kind of four main options for things that tend to benefit from stock market volatility. Those tend to be the utility sector, that's actually outperformed nicely the last several weeks, gold itself, which we can maybe touch on, Usually long duration treasuries, not yet. I think that's still coming. And then betting on the dollar from a currency perspective, because usually in a volatile equity market, there's a flight to safety into the greenback. Those four tend to be not only leading signals of volatility to come, but also beneficiaries.
You mentioned gold. Let's talk about that a little bit more. We've seen quite the run up in gold. And a lot of people wondering, all right, is 2,500 the next big marker that we can get to and still see some type of momentum? What are you tracking there?
So it's interesting. I put a piece out on Investor Place yesterday. I'm actually blown away with how quickly people are willing to say that the trend for gold is now broken. You had a pretty sizable down move a couple of days ago.
You don't think it is?
I don't, because I don't think a trend breaks when you have skepticism, right? I think you need to have certainty. When you have too much certainty, that's what creates the turning point. The fact that people are still doubtful around gold still continuing probably tells me that it's going to keep on going. And I've said this before, I think gold is sending a warning. I thought it was sending a warning about war.
Yeah.
It may still be doing so. I think it's also maybe sending a warning about the yen, currency potential crisis that we may be starting to be in. So I don't think it makes sense to necessarily panic out of gold now. Gold has done nothing for a decade plus, right? So it's only just now starting to wake up.
You mentioned geopolitical uncertainty and whether there's a correlation there to gold. Sure, certainly in the past there has been. And so there's largely the question of what that also means for other elements of your portfolio that hinge on geopolitical uncertainty, or what we would typically bucket as maybe an exogenous threat, to the extent that something arises that we did not anticipate at all, even that in that geopolitical realm.
So I go back to path matters more with prediction. So let's say markets were to take a big hit because something happens overseas. If you got a long enough time frame, that's going to get resolved, right? If you're trying to be more active and tactical, all that means is just lower your risk profile. Still be long, because for all the concerns around geopolitical risks, it may not actually plan out, or it may not plan out in the time frame that you're thinking that it will. That goes back to why market timing doesn't work. So I think when you're in these kind of junctures, the best thing to do is just lower your profile, be prepared. If you have a long enough time frame, it really doesn't matter.
Michael Gayed, who is the Title Financial Group portfolio manager and publisher of the Lead Lag Report. Thanks so much for taking the time.
Appreciate it. Thank you.
Absolutely. Everyone, let's do a quick final check of the markets here as we're taking a look at the U.S. major averages. Look, I did the best I could. I tried to keep us in positive territory. There's only so much I can do here, though. We are down across the board for the Dow, the S&P 500, and the Nasdaq as of right now. A lot of big earnings reports that have come out this morning, plus many more to come after the bell. All eyes are going to be on Meta and some of the major tech companies, some of those Mag 7 participants that are reporting this week, and then even as we get into next week. Oh yeah, Apple, that name, that household name that you know. They're going to be talking their own results. Well, I'm Brad Smith. You've been watching Wealth here on Yahoo Finance. We'll see you tomorrow at 11 a.m.